Nigga, you should too. If you knew what this gang would do to you, been in this shit since '92. Look at the bullshit I went through. Fuck if you female on who? Fuck if you female stalker too. Not to be fucked with. Me and my dog was cook shit. No inspiration for change. Spit your claim, count your shit, grab your gas, call your click, squeeze that clip, hit the right one. All them things got the right one. All them things got the right one. All them hoes got the right one. Our situation is a tight one. What you gonna do? Fight or run? Nigga told me cash was everything around me. Cook the coke, cut it. Nigga would have been fucking it. Who's the killer? Me or you? We'll see. Triple six rivals. One. We ain't talking, we shooting. Woo! Vagina. Man. Make my diamond go. It's moving, baby, baby. Babe. I'm calling my boys to bring on guns. Red, red, rum, 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 rum. Red, red, rum, 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 rum. Red, red rum. Let's go and dig it, baby. But the thug, yeah. Yeah. Mm, all right. Always got to go through that. So, yo, 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 yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall. And I've returned today to weapon tap on your head with more ADH wealth solutions. So today, we're doing a part 2 of, I guess it's weekend socioeconomics, but part 2 to wealth beyond Wall Street. So yesterday we did the first 5 chapters of the book, so we'll do another chapter or 2 today, in the honor of, I guess, the fact that we're having a St. Patrick's Day parade in my town. I'll read a couple of chapters here. So, ladies and gentlemen, thank you for showing up. Make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, yesterday, we left off at the end of Chapter 5 of Wealth Beyond Wall Street, the roadmap to wealth and independence with peace of mind. So today, we're reading Chapter 6, Killing the Interest Vampire. So let's start with a few quotes. There are 2 types of people in the world: those who pay interest and those who earn it. Unknown. Now here's one for my biblical people. The rich rule over the poor, and the borrower is servant to the lender. Proverbs 22, verse 7. Banks don't lend their money. They lend the money somebody else left there. A quote from Adam Smith. So continuing in chapter 6. Bear with me one second, y'all. I gotta get me some water. I was shocked when I awoke from my zombie-like state. Much like you, my day was pretty routine. I woke up, went to work, came home, saw the family, ate dinner, went to sleep, and did it all over again the next morning. Every 2 weeks, the paycheck came in and immediately disappeared, going to mortgage payments, car payments, credit card payments, and other expenses. At the end of the month, I had worked hard, but I had little to show for it. I was a member of the financial living dead by going through the motions to pay everyone else, but not myself. Like most Americans, I was having the financial life sucked right out of me by the vampire of interest. If you're an average American, you could be paying a whopping 34% of your after-tax income in interest. Take out a 20 from your wallet, rip 1/3 of it off, and that's about how much of your after-tax income could be going to interest every year. A financial living dead. Now, Malika, I know you follow savings minus debt. What is one of the things he always does? Tells you to take out a $20 bill, enter some numbers in the calculator, and see if you got that $20 bill there. So now I'm going to start doing the same thing. Because basically this book is teaching you that the wealth beyond Wall Street is life insurance. But I'm going to let it unfold through me reading the chapters of this book. So take out that $20 bill and cut 1/3 of it. Now go try and spend 2/3 of a $20 bill at the store. So you might be saying to yourself, I shop really hard for good interest rates. I check not only the price of what I'm buying, but I also work hard to keep my credit score high so I can get a good interest rate on my purchases. Price and interest rate are the two factors everyone focuses on, but they're not the things that kill you. The killer is the volume of interest. You know what? I might send this book to Savings Minus Debt so he can read this to the debt slaves, because this is a necessary evil here. Imagine you go buy a car for $30,000 and get a 5-year loan with an interest rate of 7.5%. How much will you pay in interest over the life of that loan? Easy, you say, whipping out your calculator. 7.5% of $30,000 is $2,250. Wise money alert. Your 7.5% car loan could end up costing you more like 20.2% by the time you pay off that loan. Now, you would say, well, it only cost me that $30,000. That 7.5% on a $30,000 loan is $2,250, right? Wrong. You actually pay more than twice that much. The amount of interest you will pay on that $30,000 car loan could be up to $6,068.31, or 20.2% of the amount of what you borrow. Wait, how is that possible? It happens because of 3 letters that follow your interest rate. Quote me here. APR, or annual percentage rate. The 7.5% is the rate you pay on the balance of the loan every year. So by the time you are done paying off your car loan, you'll have paid over 20% on that loan, not just 7.5%. Here's where the volume of interest comes in. Let's say over the course of your lifetime, you finance 10 cars at $30,000 each. That's a total of $300,000. Assuming you get the same 7.5% interest on those loans, that means you'll pay about $6,000 interest on each loan, or $60,000 in interest on your 10 cars. I don't know about you, but I think $60,000 is a big deal. A really big deal. Especially when your current figures reveal that the average American reaches retirement age with only $88,000 in savings. That means you will have dumped out in interest on cars almost as much as most people save for their entire retirement. We won't even cover leasing here. Leasing cars can often turn out to be even worse than traditional financing. Wise money alert. If you thought interest on cars was hard to swallow, this might really make you sick. Home loans are front-end loaded, with most of their interest paid in the first years of the loan. Because of how often people refinance homes, over 10 or 20 years of paying down mortgages, up to 86% of every dollar you pay on your mortgage could be going straight to interest. Pause. Ladies and gentlemen, if you've ever bought a house and you don't know this, there's a really big problem, because unfortunately, you've been stuck in what they said in chapter 1 was the status quo. Why do I say that? Because everyone knows that you pay interest up front on your mortgage, and you should know this because there's an amortization schedule. which literally shows you January 1st, 2023 is your first payment of $2,000 on this $200,000 mortgage. January 1st, 2053 is supposed to be your last payment. It'll show you exactly how much money goes to interest, exactly how much money goes to principal. In the first year, I don't know, about $1,900 of that $2,000 goes to your interest and $100 goes to the principal. This is true. Somebody go to Google and type in amortization schedule. You should find one on Bankrate or anywhere where you're applying for a mortgage. But see, we get so amped and so quickly want to get into a 30-year commitment of a mortgage, but yet we won't buy a commitment of a life insurance, which I'll just let the book tell you guys the rest. So with purchase price and interest combined on your 10 cars, even if you keep them until they're paid off, you will have kissed away $360,000 on your cars. We're talking a total of 4 times what many people save for their retirement. What if you could keep the majority of that $360,000 flowing back into your pockets instead of some lender or car company? You can. I'll introduce you to this great financial tool and multiple others. Let's get started. We should have been reading this for a book club. So, Malika, you know what's funny? I am reading this for a book club. But I figured, why not share it with my audience? Because, like I said, y'all be here rocking with me. So again, ladies and gentlemen, if you are enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. Well, Malika, this is a book club with other financial advisors. So we all come together, and every month we recommend a book, and you know we consult on the book or consort on a book, and this month was this book. But I may do something like this with the folks on my YouTube. You've actually given me a great idea, Malika. And while we're at it, Malika, can you do me a favor and put your Instagram and your Etsy link in the chat so people can go see your work and the greatness that you have going on? So let's get started. Section 3, building on a strong foundation. Do you wish to rise? Begin by descending. You plan a tower that will pierce the clouds. Lay first the foundation. St. Augustine. So chapter 7, defeating the enemies of wealth. Wherever wealth is accumulated, someone will be there to try and steal it. R. Nelson Nash. Jason Smith slid into the front seat, slammed the door, and slumped forward until his forehead pressed against the steering wheel. His stomach was in knots, and a dull ache throbbed behind his temples. Another roller coaster week in the market had dropped his 401k value substantially. He dreaded facing Susan. After all, it had been his idea to max out the 401k. She'd wanted to keep her contribution smaller, to put some of Jason's salary in a conventional savings account, or maybe some short-term CDs. She worried about emergencies and about covering the kids' college expenses, all arguments that he disregarded at the time. He'd read some articles written by the industry's top gurus, and he figured he knew what he was doing. So he knew that the 401k was the most popular retirement plan in America.
He not only wanted all the free money he could get through his employer's match, but he'd heard about the great tax savings to be had from socking the maximum amount possible into a 401k. All the other guys in his department were doing it, and they seemed savvy enough. Jason had won out, and for the past 6 years, a large percentage of every paycheck had gone to his 401k. It had seemed like a good idea at the time, but that was before the market experienced a nearly unprecedented downturn that reduced the value of mutual funds and retirement accounts of people all over the country. Before he'd found out how had he not known this? That the money in his 401k might as well have been locked up in Fort Knox because it was a major pain to get at any of it. After all, it was his money. What's going on, Rael? After all, it was his money, and he needed some of it. And now, easing reluctantly up the driveway, Jason knew that what had seemed like such a good idea 6 years ago was turning out to be an emotional and financial roller coaster with more downs than ups. Jason sunk into the sofa in the living room and proceeded to tell Susan the bad news. Another drop in economic forecasts had caused a major drop in the market, which was costing them thousands with every drop. First off, his account was not even worth half of what he thought it was. His hard-earned money was gone, thanks to the volatility of a market over which he had no control. So much for his dream of retiring with millions. Second, Susan had really wanted to access some money for the kitchen remodel they badly needed. If he took the money out, he'd be slapped with so many fees and penalties, including a tax penalty, which is why I say life insurance beats the Roth IRA, but I'll let the book explain it to you, that he'd scarcely break even. Even if he decided to brave the penalties, he'd lose a fortune selling the funds in his account when the market was so low. He would kiss away what hadn't already been lost to the market crash. Finally, he didn't even dare borrow from his account. That little carrot that had been dangled in front of his nose 6 years ago turned out to have a very painful string attached. What they hadn't told Jason when he invested in a 401k was that if he lost his job, the loan would be due in full, usually within 2 months' time. I bet you the financial gurus who told you to buy a term and invest the difference and put all your money in your 401k didn't tell you that, did they? With a rumored corporate merger in the works that could result in potential layoffs, that was a chance Jason couldn't afford to take. Maxing out the 401k, not the best idea, Jason sheepishly admitted. A few days later, after a few emails between friends, Jason got a link to a website that helped him to figure out when he would run out of money in retirement. He was intrigued. It would tell him how long his retirement savings would last. He started punching in numbers, thinking things couldn't possibly get worse. And while he was a bit shocked at what he saw, he also got some good news. The bad news? Jason Smith would run out of money at age 71. Simply put, based on his current plan and the income he felt he would need during retirement, he would only have enough income till he reached age 71. 71? Jason wondered what he would do then. So imagine this. Now, just think about it, because the average person is thinking they're retiring at maybe 65, right? Everybody, I want to retire at 50, but realistically, that doesn't happen for many Americans. So he's thinking, okay, let's say he's 40 now. So he's thinking, okay, I'm going to work another 25 years. I've been socking money away for at least the last 6 years. I work another 25 years. And based on that, if I at 65 retire, so that's 6 years of retirement income. So he socked all that money away for 6 years to literally just have 6 years worth of money. That's not a return on your investment. Oh, wait, but we forgot about that thing that we talked about earlier in chapters yesterday, inflation. So let's assume at that 4% annual compound interest rate, every 18 years, the cost of living doubles. So in 25 years, right, we're assuming he's 40 today, in 25 years, that money that will last him 6 years in today would actually only last him 3, because the money would be cut in half, the spending power. Damn. So let's continue. 71, Jason wondered, well, what would he do then? As visions of greeting customers at the local warehouse store clouded his thoughts. You guys know I always say about with your 401k, it pays out period certain. And then at 75, you gotta go back to Walmart and check receipts. And what does this book say? As visions of greeting customers at the local warehouse store clouded his thoughts, he noticed the website offered a way out, and it could all be explained by an insurance professional. Let's just say it was a hard sell for Susan. We can imagine why she might be just a little skeptical about Jason's financial know-how right about now. Reluctantly, Susan agreed, and Jason called to schedule an appointment with a professional insurance agent. They had a short 20-minute conversation with Mike. At the end of the conversation, he offered them a customized blueprint to help them grow their money outside of the stock market with major tax advantages. He offered to show them how the entire process works in black and white right in front of their own computer. Rob, what does this sound like? Something I do all the time? I know, folks, it just seems too good to be true. It's funny, this book is actually opening my eyes to the reluctance now when I see clients, because just like it's a reset with the debt matrix, I understand there's a reset with the wealth matrix. This book has just helped me to help y'all, because I can see people glitching all the time when I show them this insurance and they're like, it doesn't make sense. Rael and I be having these conversations all the time. He'd be like, yo, man, this is some deep mess. So I'm not being biased, but I am being biased to my audience, because I get a lot of black folks who brain fart. It doesn't compute, because we've been taught the status quo. These two white guys here wrote this book, Wealth Beyond Wall Street, and right here, it just told them the answer to all those problems is a professional insurance agent. So, he offered to show them how the entire process works in black and white. No, Malika, you weren't reluctant. Don't worry. From their own computer. And even if you were, you pulled the trigger. So that shows things beyond reluctance, right? A lot of reluctance, people will be like, oh, I need to think about it. I have to ask my wife. Well, I've showed it to you in black and white. Most people will hesitate. Fine. Just waste your time. Malika, you took action, so worry not. Michael is one of the few professionals specifically trained to implement these solutions. So he uses the phone and internet to help people all across the country. It was done using a 100-year-old proven strategy for keeping money growing outside of Wall Street. It came with the potential for growth if the markets went up, and with complete downside protection, although you would still have to pay fees and the cost of insurance. If structured and funded properly, it could also give you the ability to access your cash value throughout your life. In fact, that was one of the major benefits, that you could use it to finance yourself to wealth, meaning you could borrow against your cash value for major purchases like cars, college tuitions, or vacations, and then pay your loan back to yourself with the cash and continue to grow. You could pay yourself back while the cash continued to grow as if you hadn't touched it. Of course, it would be important to have other long-term savings in case of an emergency. Jason was particularly intrigued because of that idea. Ultimately, it was a way to possibly reduce the amount of interest he would pay to banks or to credit card companies. No doubt, bro. Let's take a break in the story while we're waiting for Michael to call and get a few of the basics out of the way. Because whether you have a 401k or not, this will be new information. Well, not for a bunch of the people who follow me. This isn't going to be terribly new. And again, this is my first time reading this book, but generally, especially when I see books like this and I already know what they're talking about. Maybe I should write a book. I think I'm going to do that. And just literally do what these guys did. So, and like G.I. Joe says, knowing is half the battle. And again, you should talk with a qualified financial professional for more details about this and other strategies mentioned to better understand if they are suitable for your situation. You might have assumed, just like our friend Jason, that a 401k or mutual fund was a solid way to save for retirement. After all, that's what many of the pop culture gurus advocate. Right out of the gate, let's see what one financial analyst had to say about it. The American public has been hoodwinked by the political and corporate forces into relying on the 401k as the primary long-term investment mechanism. In doing so, the stock market has been put at center stage in providing for a comfortable retirement for the average American. The 401k represents an implicit promise to middle-class Americans that they can live off the income that they receive from stock ownership, just like the rich do. It is a promise that is impossible to fulfill. It is the great 401k hoax. So we're going to talk about, no, Seeking My Creator, he wouldn't. The way savings accounts, unless you have a high yield or a high interest savings account, you're not going to earn interest. So a savings account is going to leave you flat. Savings accounts earn simple interest, and they earn APY, annual percentage yield, similar to the term we spoke about earlier, APR, annual percentage rate. So currently, I think that the highest yield, high interest savings account is Marcus Millichap, aka Goldman Sachs, which is 0.5%. Generally, that's on a minimum of a $20,000 balance, and you have to leave that money in there for the entire year to trigger or earn interest. See, a lot of these quasi-financial gurus will tell you this, that, and the third, but they don't tell you the real. What's going on, eyes? So hopefully y'all watch this back, but y'all are about to hear a whole bunch. So hoax sounds like a pretty strong word, but that's potentially what the 401k plan is. Here's a quick crash course on 401k plans. Money in a 401k is often invested in stocks and mutual funds. If the market goes up, so can your money. If you have money in a 401k with stocks or mutual funds, your money could be at risk for loss as well. That means if the market goes down, you can lose. Lastly, your 401k contributions are made before you pay taxes on the money. So you're taxed as you withdraw money from the plan. Here's where you see that you are being taxed on the crop, not the seed. If you watch the 3-hour video from yesterday, you'll understand this because I read the first 5 chapters. And don't forget, your money could be tied up until you retire. And that's not just in a 401k, that's also in an IRA. And for those who think they're going to get tricky and do, oh, well, I could do post-tax dollars with a Roth IRA. IRA rules still apply to a Roth. Yeah, you don't get taxed at regular income, but you can't touch that money until your retirement age. And if you want to do things like purchase a house, you can only borrow a maximum of $10,000. Okay, you were 10 minutes behind. 6 years of saving that barely covers 3 years. No problem seeking my creator. Phil, welcome to, trust me, I'm not going to be as long as I was yesterday, but, you know, I do appreciate everybody who's coming in. And ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional who actually knows how to implement these processes, the links are in the description of this video. Now, let's get back to the meeting with Michael. It's 5 p.m. on Thursday evening, and Jason and Susan are sitting in front of the computer when Michael calls. Jason is all ears, but Susan is feeling but Susan is feeling like she's just had the proverbial blanket yanked out from under her feet with the 401k debacle, is hanging back. Still skeptical, she goes for the jugular with this comment. I need to ask something right up front, she says. Michael welcomes the question, and this is what I result to dealing with all the time, because people think, oh, it's just insurance. These financial other people who were telling me about all this other stuff pulled the rug. So now I'm extra skeptical. And I'm like, listen, man, you are dealing with the dumb. I'm Teflon. And when you're looking at life insurance, it's a wealth contract. It's a tax shelter. It's going to beat the bejesus out of everything. But you've been told to lay on the status quo. Watch yesterday's video so you'll know. So I need to ask something right up front, she says. Michael welcomes the question. After detailing what just happened with her 401k, Susan squares herself up in the chair. We've listened to other financial gurus and advisors, and it's gotten us where we are now. Why should we listen to you? She asks, which again, that's what I get all the time, because people come to insurance last and they're like, well, we listen to all these other people. Why should we listen to you? I tell them, because you came to have the appointment with me. That's why. Thank you, Oz. I understand your skepticism in talking with another financial professional. The difference is I'm focused on alternative strategies. I help people build a strong foundation so my clients don't experience a negative crediting on money in market downturns. They would still have to pay fees and the cost of insurance, but 401k plans or mutual funds can be the risky can be the risky for the bulk or all of your money, as the market can have volatility. Michael explains. Wealth Talk, what's going on? In fact, depending on how you direct your contributions, it could put your entire retirement principal at risk. Susan, clearly frustrated, glares at Jason. Tonight, I'm going to talk to you about some of the biggest enemies of building wealth, and also about how you can start on the path to becoming a wealthy outside of Wall Street. A couple of the threats that we must protect to build wealth are: 1, the actual loss of your money in the market. Once you lose money, it can take a substantial amount of time to make it up. 2, taxes. And 3, interest. Many folks don't know it, but they could be paying up to 1/3 of every dollar they make towards interest of some sort. This is essentially making them employees of the tax man and the lenders at the same time. Let's talk about putting your money at risk of loss. To begin, let's look at how your mutual fund or stock performs. How much money you end up with for retirement usually depends completely on the market, Michael explains. The market is uncertain. It can go up, it can go down, or it can stay flat and completely out of your control. So your future is tied to how well the market cooperates without any input from you. Hold on, ladies and gentlemen, because I got to get back in my bag and stand on my soapbox. This is why I preach, and even if you look in my about, I talk about alternative strategies, using life insurance for things like college planning, retirement planning, elder planning, you want to buy a house, life planning, wealth. My next thing is just going to be wealth strategies using life insurance. Because it's a Teflon product. Literally what most Americans go to the stock market. Oh, you probably shouldn't do that. Why? Because that's what the banks want you to do. Yes, you are subject to people's emotions in the stock market. Now, there's nothing wrong with participating in the stock market if you have the risk tolerance for it. Like we read earlier, Suze Orman has $1 million in the stock market, but she's worth over $100 million. So she has 1% of her net worth in the stock market, or $1 million. Right? Now, she's like, yeah, I only have $1 million in the market because if I lose $1 million, I really don't care. So again, none of these, what did they call, what did he call these fake financial gurus? What is it? The pop culture financial gurus, none of them mention your risk tolerance, which is what Suze Orman been saying. So let's continue. While Jason and Susan tried to wrap their heads around that piece of information, Michael started asking some pretty tough questions. So Jason, how much do you really know about your 401k? Clearly not as much as I thought I did, Jason mumbled. Well, let's start with your 401k manager. Do you even know who it is? 99.9999999. I'm willing to bet 100% of Americans don't know who their 401k manager is. Jason shakes his head and Michael goes on. Do you know what funds you're invested in or even what companies your funds invest in? 99% of people have a target date fund, like the 2035 fund, etc. So I'm going to say again, about 100% of people don't even know what their funds are, they're in. I'm going back and forth between real life and the book, y'all. Most people enrolled in 401k plans can't even list the funds or companies in which they are investing. That's risky business. Interesting, Susan smugly replies. That sounds more like gambling to me. Yes. How often do I say this, my followers? There's more, Michael says. I know that you've already found out about some of the tax implications. Think about this. If you don't like paying taxes right now, what makes you think you're going to like it any better 20 years from now, when you start to withdraw your 401k money for retirement? You're going to have to pay taxes on it. That means if you're in a 28% tax bracket, you could have about 1/3 less actual money than you have in your account. A quick tip, in a 401k plan, you'll be paying taxes on the crop, not the seed. And this is called tax savings? What an irony. People invest in a 401k plan to save taxes today, but in reality, they could end up actually paying more in taxes when they retire. Not only because they're paying on the crop, but because they could potentially be paying in a higher tax bracket when they begin taking distributions from their 401k plans. So I'm going to pause from the book. The reason that people think that they get tax savings with their 401k is because, yes, you save money today on taxes, and then they figure, well, by the time I retire, I'm retired, so I won't be in the same tax bracket because I won't be making as much money. But they don't explain to you that a 401k gets taxed as ordinary income at retirement, at distribution because you didn't pay taxes on it when you contributed to the 401k. So because you didn't pay taxes on it then, you have to pay taxes on it now. So you have to pay taxes on the principal and the gains. You do not pay only capital gains taxes on the principal. You pay regular income tax on the principal. And then anything above the principal, you pay capital gains tax. So even in a Roth, yes, you've paid taxes on the money you put in, but they don't tell you on a Roth IRA or a Roth 401k, you still have to pay taxes on the capital gain. Right? So again, most people think that, well, at retirement, when I'm in my late 60s, I won't be working, so I won't be having as such a high tax bracket, so I'll be better. But they don't understand how they're going to be taxed. You're getting double taxed because you're going to pay taxes on the principal and taxes on the capital gain. So let's go back to the book. And ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. Hey, Broke Genius, I think you wrenched up. Do me two favors. One, I got to link up with you because I'm about to write a book. After reading this book, I already got the name on my book and everything. I'm going to do everything that these cats are saying or these cats is doing with a lot of fluff. And then like the last 8 chapters will be the stuff. But I'm about to write a book and you've already done so. So I'm going to holler at you in terms of the process in doing so. But yeah, put your link in the chat so folks know where to go get your book too. Right? Because if these cats can talk about being wealthy beyond Wall Street, especially in this black manosphere, this is the agency that we want. We got folks like myself, folks like the Broke Genius, folks like Rael. Rael is part of the reason that Marty McFly is my client. You know why? Because he had agency. He said, yo, here's a black man in here in this space. Let me tell you, what you're talking right now, you need an expert. No wrench yet? Let me get you a wrench. All right, you should be wrenched up now. But Rael was like, yo, Marty, I hear what you're talking and it sounds good, but I'm gonna need you to talk to an expert in the subject matter. He hit me up. Yo, bro, I'm gonna need you to get on this, what's the name? I got a brother that you need to speak to. I go up there. Yo, what's good? Da, 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 da. Boom, boom, boom. Marty is the guy that I always brag about in these spaces who put $500,000 away with me in a retirement account. Now I know that's funny. I'm talking about the negativity of retirement accounts, and then I put the brother in the retirement account. But excuse me, that's a different type of a retirement account. So just like we've got, and Rael will always, tell us about this. This is black male agency, and this is, I'm not ignoring the females right now, but it's a man's world, and this is what we do. Make sure y'all also look for Malika's link. So this is going to be like the National Negro Business League. Anybody I know who comes into my chat, if you have some form of business, you're welcome to drop the links, and we're going to network here. This is going to be like a LinkedIn. It's time to play no more games. We talk enough about dick and pussy online. Right? So now we about to talk about how our network is our net worth. Right? So, back to the book. I'm sorry. So you've got 3 children, right? Michael asks. Susan says, yes. If you don't manage to use up your 401k during your retirement, it'll be passed on to your heirs. Not only could they face income tax on the money they receive from your 401k, but they could also have to pay estate taxes as well. There's another issue with a 401k plan you need to be aware of. Dun 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 dun. Fees. Many folks don't know how much in fees they are really paying. Unfortunately, it can add up to a substantial sum, and the fund managers always get paid, whether your money grows or not. Jason slaps his palm against the table. I feel like I've been misled, he cries. Our HR guy pushed a bunch of papers in front of me and encouraged me to sign on the dotted line, all the while touting matching funds and company support. But he never said anything about getting out. All the gurus on TV and everyone else for that matter says to max out my 401k. He said the Silicon Valley boys bought too much coke. Now, I'm going to tell you the truth, broke genius. They ain't buying enough coke. That's why they ended up in the bad situation. Susan clears her throat loudly. Oh yeah? Well, everyone except Susan, Jason admits. Now, both Jason and Susan are now ready to listen to Michael. He showed them why the old way wasn't working. Jason feels like he's learned more about the 401k program in the last 20 minutes than in the previous 2 decades. Pause. Here's what's funny. Actually, Malika, I think you've said this to me as well. I get this often when I sit with a lot of my clients. They're like, wow, I learned more today than I learned with all the other financial people I've been watching for the last 20 years. Like, this book right here is just clicking with me. And Rael said something that made a whole lot of sense to me years ago about my skill set. I think you said this when I first came into this space, bro. You have a specific, I feel like I'm in the movie Taken. I have a certain set of skills, right? But that set of skills, y'all, Queena, what's going on, mama? I have a certain set of skills. That set of skills is very specialized. And now that I'm reading this book and I'm seeing what the white guys are facing, it's easier for them to get into a lot of households, but they have the same issues. But definitely it happens here. So, Susan, who's softened a little toward Jason, says, I'm feeling ripped off too. Just yesterday, I read a column by a well-respected financial guru. Her advice was buy term and invest the difference in mutual funds. It's ironic that she was the spokesperson for TD Ameritrade. Jason chuckles. Yeah, we've both seen the results of those. How efficient do you think the average business would be if it suffered constant turnover? In other words, if new people came in on a regular basis, bringing new ideas and new ways of doing things. Well, that's what happens with mutual funds, except instead of people, the turnover involves stocks. In other words, excessive trading in the portfolio. Mutual fund managers are constantly changing the stocks in the portfolio. Translation, you never know from one day to the next exactly what's in your portfolio. In the 1950s, the average portfolio turnover rate was about 15%. Today, 100% turnover is commonplace. As much as 300% turnover is typical. Just a few years ago, Forbes magazine reported turnover rates so high that even the reporter was astonished. Rates ranged from 523% to a staggering 827%. The result of all these turnovers is that the cost of doing business for mutual funds, instead of going down, has doubled since the 1950s. And who pays for the increased costs? That's right, the investors. You lucky dogs, you. We all watched as the market toppled, says Michael, taking with it the retirement dreams of many Americans. Even those who had enjoyed growth watched as the value of their nest eggs were nearly half their previous value, and they felt powerless to do anything about it. But you know what? Michael continues. Even without the correction we recently witnessed, there are always ups and downs that we can't control. Studies have shown that over the past 180 years, that the average market return after factoring for inflation is as low as 1.2%. Here's what it amounts to, Michael says. As an investor, you put up 100% of the money and you take 100% of the risk. If you're the one whose principal is on the line, this is fine if you have money that you can stand to lose. But this is not the way that savvy investors live. They build a solid foundation and protect the principal. Yeah, I found the site because a friend referred it to me. I liked what I read there. It was really eye-opening. I felt like it was time to try a different approach. I felt like it was time to try a different approach. Susan interjects, the Wealth Beyond Wall Street program sounds good to me. It does make sense, Jason agrees, but I'm not sure what to do at this point. I feel stuck in my 401k, which I can't get rid of, and I'm not thinking I can afford any mutual funds for a while. At least not until we pull out of the hole we're in. So what do we do now? Michael laughs and says to Jason, I've got great news for you. Now, pause before we go on. This is the major issue why it is also great to make your children wealthy beyond Wall Street. People always think about life insurance as death benefit and then want to get all these other products because it sounds nice, right? So, prime example, Jordans sound nice. So people spend an exorbitant amount of money on Jordans. But are Jordans not Air Force Ones? So, Air Force Ones, Nikes versus just sneakers, right? So now let's say everybody's getting pushed to go buy Jordans, right? But I've got over here a product, all I call it is sneakers. By the way, all Jordans are is sneakers as well. They just don't call it sneakers, they call it Jordan. But I have sneakers as well. And the sneakers that I have for you are literally custom to your foot. Like they hug every single toe. They make sure that your foot is absolutely comfortable. It supports every arch. If you got bunions, it won't make it hurt. If you got corns, it won't make it hurt. You got long toenails, it won't make it hurt. It'll groom your feet. It'll give you a pedicure every time you step into them. But because everybody's like, you got to buy Jordans, you go and buy Jordans. I don't even know the difference between shoes and me neither, Malika. But so he says, Michael laughs and says, Jason, I've got great news for you. It's about time I got some good news for a change, Jason says and laughs. You're a whole lot better informed now than before our meeting, Michael points out. And now I'm going to show you a couple of alternate solutions and how you can get on the right track starting today, regardless of your situation with the 401k. I think we'll find some good solutions together. I'm going to show you multiple strategies that will keep your money out of the market and offer strategies that will allow you to finance yourself to wealth and receive interest that builds cash value based on the performance of the underlying index. Uh-oh, is he talking about IULs? You could better manage the amount you pay in interest to banks and credit card companies, plus have access to your cash value throughout your life. Sound good? Jason looks like he's about to cry again, this time from relief. So I've been going for an hour. I'm still going to keep going, ladies and gentlemen. Give me one moment there. Ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So chapter 8, would you like guaranteed income for life? Let's read a quote. Peace of mind is the basis of a healthy body and a healthy mind. Dalai Lama. You're here because you're afraid of outliving your retirement income, right? Michael asks, not missing a beat. Yes, Susan blurts out and then frowns apologetically at Jason. Michael nods. Many Americans are afraid of that too. People are living longer than ever before, and today one of the biggest concerns on the minds of many is outliving their retirement income. Even if you've saved a substantial amount of money throughout your lifetime, a retirement that lasts for 20 or more years could easily stretch those savings to far beyond what is required, even for just your basic monthly needs. Unlike retirees in the past who typically had more than one guaranteed income source to count on, the same may or may not be a reality for you. For example, the defined benefit pension plan, also simply referred to as the pension, is quickly disappearing in favor of 401ks. Insurance companies started killing the pension and selling the 401k because insurance companies make way more money off of the 401k than they do the pension. Because a pension means payment till death. A 401k means period certain payment. So if you have $88,000, which apparently is the average, that means you get $8,000 a year for 10 years. And after that, you got to go check receipts at Walmart. My father had a pension. He never had to worry, Jason said. Michael nodded. Many Americans had pensions, and for participants in a pension plan, the employer would promise to pay a set amount of retirement income for life. And because of this, the liability of the pension rested entirely with the employer, not the employee. So you'll hear some municipalities that still have pensions. A lot of first responders have them, policemen, firefighters, EMTs, stuff like that, teachers, stuff like that will have pension. But those pensions and mutual funds had a lot of fees. So you may have heard of a company called TIAA CREP, which is Teachers Insurance and Annuity Association. Unfortunately, due in large part to the expense, most employers have done away with the defined benefit pension plans over the years and have instead turned to offering defined contribution plans, the most popular of which is the 401k. So defined benefit and defined contribution. Defined benefit is a pension where the job says, listen, when you retire, we're going to guarantee that we give you $2,000 a month until the day you die. Defined contribution is, hey, we're your job. We'll match up to 4% depending on what you contribute. So you say, okay, I'm going to contribute 5% of my annual income. So we're going to match up to that we're matched up to 4% of that 5%. Defined contribution. This way, it doesn't define exactly how much money you're left with, so the risk is on you to make sure that it performs instead of on the company. Now, let's go back to the pensions. Again, we know that a lot of these municipalities were bleeding their pensions dry. Look at Detroit and people like Kwame Kilpatrick. They bled these pension funds dry. All we know, and we all know how problematic a 401k plan can be, Michael says while Jason nods. We sure do, Susan says. Now, how much is enough? Over the past decade or so, we've been literally deluged with negative news about Wall Street and what's happening with our country's economic and financial situation overall. And rightly so. Job losses, rising prices, and uncertainty. It all can make it difficult to save for the future. It has been estimated that the stock market crash erased nearly $7 trillion of investors' wealth in 2008 alone. And many people have not yet fully recovered from that. But even if you have been setting aside a decent amount of money for retirement lately, the still volatile stock market combined with the historically low interest rates have provided more than just a slight challenge to ensuring that you will have enough. What exactly is enough? Well, that depends. You've likely seen ads that tell how you need to reach your number or hit your retirement red zone. But the reality is that what matters the most in retirement is that you have enough income to pay for the things that you need and the things you want. Plus, you'll need to be able to do so for a longer period of time than your grandparents, and maybe even longer than your parents did. That's because our life expectancies have gotten so much longer today than ever before. I told you on life insurance policies, they're illustrating out to 121 years old. Back in 2012, when I first got into this industry, one of my first clients was an old lady who had a life insurance policy with MetLife that had endowed on her. What does endow mean? That means she outlived her whole life insurance policy. This policy was purchased for her in the year 1939. But when I sat with her, she was like, they sent me a check. Why did they send me a check? Because, ma'am, you outlived your life insurance. So they're not going to accept payment from you anymore. And they're not going to extend this coverage. Now, in 1939, the death benefit was $1,500. But her premium was 10 cents a month. Now, in today's economy, it takes strategic planning. He says, my uncle just told me my grandfather's neighbor. Wow. Yeah, think about that, bro. Most people have in their 401k, let's say the average, I think, as of today is $168,000. So that woman who's currently 98, let's say she retired at 68. With $168,000, let's just call it $170. That is $17,000 a year from 68 to 78. At 78, she ran out of money. Ain't no dough in that 401k left. So at 78, she had to go back to working at Walmart, bro. Damn, he said, to put things into perspective, my house is 103 years old. Damn, so she's up there, bro. But facts. So think about, obviously, inflation. She's seen a lot of inflation. Right? She's seen it go from 0 to 100, nigga, real quick. So in today's economy, it takes strategic planning to ensure that you have the income you need when it comes time to retire. Unfortunately, just simply investing some funds in the market every month won't do the trick. And having just some income won't do the trick either. Yeah, see, they had pensions back then, but you know, if they had a 401k, when she retired, she'd be working at Walmart. Thank God she had the pension. For example, some people find that when they get to retirement, they have an income gap, a difference between the amount that they need and the amount that they actually have coming in. The time to fix that is now, not then. Excuse me. So is your retirement plan on track? Even if you have some guaranteed income sources, Michael continues, such as Social Security, it may not be enough. Oh yeah, FYI, ladies and gentlemen, FRA is 67 for retirement age. But it's a 401 negative pay. That's what they need to call it. Full retirement age as of today, if you were born by or after 1967, is age 67. If you are not, if you're after that, like if you're like most of us here who have been born in the 70s and 80s, some of my followers maybe even the 90s, what do you think we're getting? If folks are living longer on Social Security, we're contributing less to Social Security due to things like self-employment and the gig economy. If they're pushing RMDs to the age of 75, what do you think they're going to do to FRA? See, RMDs right now are at 72, and retirement age is 67. So if RMDs are going to be at 75 in the year 2025, what do you think they're going to push full retirement age up to? 71 or 72? But see, these social media financial gurus will have you thinking crypto is the play or investing is the play. Well, yeah, exactly, the play instead of the way. So, did you know that the SSA itself states that this benefit was never meant to be the only source of income for people when they retire, Michael asks? Susan and Jason shake their heads. According to the Social Security Administration, Michael says Social Security replaces only about 40% of an average wage earner's income after retirement. So, if you don't receive income from a defined benefit pension plan, and you're only able to replace about 40% of your income from Social Security, if this program still exists at the time of your retirement, then where will the income that you need in retirement come from? A strategy that can create safety with a potential for higher interest based on a positive change in an external index like the S&P 500 is something called an indexed annuity, and it's a very popular retirement strategy, Michael says, smiling. God diggity damn. Malika, can I use an example of real life? See, Malika is my real life client. And we have some things like this. We've had this conversation. So don't be afraid of your future, Malika, because you've got your future planner right here. So we're working on those things. So, Michael says, smiling. Let me stop you right there, Jason says, his smile quickly fading. I know all about annuities, and we aren't interested. He sits back in his chair, crossing his arms in front of his chest. Why? Michael asks. What have you heard? The fees are high. Ah, Michael replies, leaning back. Now this guy's just, oh, we ain't interested because we heard about these fees. Now you heard about all this good shit about the other shit, the shit that you hearing bad shit about, the annuity. You ain't put a dime in because everybody's like, oh, nah, it's bad. There are fees. But nobody told you about these fees that got your heart in your stomach right now, Jason. So, why, Michael asks, what have you heard? The fees are high. Ah, Michael replies, leaning back. You're probably thinking of variable annuities. We don't recommend them because of the high fees like you mentioned. We also think they don't provide enough protection to justify those fees. Okay, Jason says, dubiously. There are several different types of annuities, and some can help ensure that your money is protected in any type of market, and you can count on having guaranteed income for the remainder of your life. So, ladies and gentlemen, part of the reason I call myself the All-Star Advisor and a true financial professional, because some of your social media financial gurus, who may even have their insurance license, don't know that they can sell you an annuity legally. They don't know that they can sell you an IRA, a 457, a 401k, a SEP, a simple IRA, a Roth IRA, a profit sharing program, a 457. Shit. Most of them don't even know what those items are. They're tax code for the most part, by the way. So I'm very skeptical, Jason says. I understand that, but hear me out, Michael replies. The money inside of an annuity is allowed to grow tax deferred. That means, unlike your regular investment accounts, you won't have to pay taxes on the gains until the time you withdraw the funds. Also, unlike other qualified tax deferred accounts such as 401k or IRA, which are subject to IRS contribution guidelines, a non-qualified annuity means it doesn't have a maximum annual contribution limit. This means that you aren't limited to the amount of premium you can pay into an annuity. However, each insurance carrier will have their own maximum limits, and the interest you earn can still get the tax-deferred growth. So if you've already maxed out your employer-sponsored retirement account and or personal IRAs, then the annuity can provide you with yet another avenue for obtaining tax advantage growth on your money. No limits? Really? Jason asks. Yes, really. Some types of annuities will also offer the ability to earn market index linked growth, while at the same time protecting principal in the event of market downturn. This scenario can allow you to obtain growth without all the risk of the stock market, all while protecting your nest egg. And because of the annuity's lifetime payout option, you don't have to worry about income running out, because the annuity will continue making income payments for the remainder of your lifetime, regardless of how long that may be. So, ladies and gentlemen, let's use this scenario. Remember, like I said, lifetime income option versus period certain. 401k is period certain. We're going to say you have $200,000, you're 65 and you retire. $200,000 is $20,000 a year for 10 years. At 75, all your money is gone from that 401k, so now you have to go work at Walmart. Same scenario with an annuity with a lifetime income option payout. $200,000, you're 65, you retire, you receive $20,000 a year for 10 years. All the money that you have in that annuity is gone. Now you're 75, what do? You keep receiving $20,000 a year from the insurance company until the day you die. Oh, but that's not what everybody keeps telling you to do. Why? Things that make you say, So, that sounds really wonderful, Susan said. Did you say there are several different types of annuities, Jason asked? Yes, I did. And which one you choose will depend on your specific goals and whether you are already retired and looking for income right now, or you're still in the accumulation stage and will be in need of retirement income in the future. First, an annuity can be either immediate or deferred. This refers to when the income payout will begin from the annuity. And I done erased so many videos that I done on this shit, and I done this shit over and over and over again, but it gets ignored. Well, you know, no problem. Unfortunately, the reason it gets ignored is because you're bombarded with a deluge of the other stuff. It's funny now how when you hear about the fact that Sue Zorman tells you buy term, invest the difference in mutual funds with TD Ameritrade, you find out she's also being paid by TD Ameritrade. It's funny how you find out when Dave Ramsey says buy term and invest the difference in a mutual fund. It's funny that you find out that he owns a term life insurance company. It's funny how when the banks tell you buy term and invest the difference, they also don't show you the BOLI report, bank-owned life insurance. Go to Google and type in what is BOLI, bank-owned life insurance. It's how they fund retirement accounts and shit. Well, 1 year, back in 2018, Bank of America put $6.1 billion into equity investments without readily determinable fair values, aka the stock market that they herd the sheeple to. Meanwhile, they just put almost $22 billion into cash value life insurance. It's just like school, right? The teacher doesn't give attention to the bad students. They don't give extra credit or they don't give the gifts and stuff to the bad students, the students that are disruptful. Yes, that's Sue Zorman. But let me continue. So now, actually, folks, he's about to break down a little bit about the specific products. So let's go. So immediate annuity. With an immediate annuity, the income payout will begin shortly after you purchase the annuity. These annuities are typically purchased with just one lump sum or a single premium. You may also roll over your retirement plan funds, such as an IRA or a 401k, into an immediate annuity. The assets that are in an immediate annuity do not continue to accumulate, but rather are simply used for the purpose of distributing income. If you're already in retirement, you may want to consider an immediate annuity by just one lump sum premium payment or rolling over your retirement account. This type of annuity can generate an ongoing income for you throughout the remainder of your life. Many annuities can also generate guaranteed lifetime income for a second individual too, such as your spouse or partner, although the other individual does not have to be related to you. Deferred annuities. So if you have a deferred annuity, the income payout will begin at some time in the future. Because of that, the funds are inside of a deferred annuity and it will accumulate on a tax-deferred basis. You can pay your premiums into a deferred annuity via either a single lump sum or through periodic premium payments over time. The funds that are inside of a deferred annuity are also allowed to grow on a tax-deferred basis. This means that no tax is due on the gain until the time the funds are withdrawn. Because you may be in a lower income tax bracket at retirement, you could realize a nice amount of tax savings. This is the principle that they're trying to lead you to with a 401k, except for the fact that there are fees and you have to pay capital gains and tax on the principal. With a non-qualified annuity, you've already paid tax on the principal. All you have to pay is tax on the capital gains, just like a Roth IRA. Another distinguishing feature about an annuity is whether it's fixed or variable or indexed. This can make a difference in the way that the underlying account performs, says Michael, as well as the guarantees that you have within regards to your principal. What are the differences, Jason asks? With a fixed annuity, the offering insurance company will provide you with a fixed amount of interest that is credited into the account on an annual basis. A key benefit to owning a fixed annuity is the safety of principal that it can offer you, as well as the steady and known stream of income in retirement. The trade-off for that, however, is that the return with a fixed annuity will typically be pretty low. This is especially the case lately, as over the past several years, we have been in a very low interest rate environment. Because of this, many people have shied away from fixed annuities due to their lower returns. Low returns aren't very exciting, Susan says, frowning. Yeah, they were at 1%. But get this, yesterday, actually this morning, I just signed a little $300,000 annuity with a client. And I was like, bro, I like to underpromise and overdeliver. The last annuity we did, I was getting you 3%. I told you I'd be conservative and I'll get you 5% this time, right? He says, yeah. It says, look at the paper. He looks at the paperwork. He's like, you motherfucker. I was like, what's wrong? He said, you fucking lied to me. What? You said you were going to get me 5%. What the hell is wrong with you? I said, well, what do you see there? He says, you're not getting me 5%. You're getting me freaking 9%. I loved you. I'm getting him damn near 10% growth. Sick, right? Sick. So Michael laughs. No, they aren't. If you want potentially higher returns, a variable annuity will allow you to participate in equity vehicles such as mutual funds that are set up in sub-accounts. Because of this, the value of a variable annuity account has the opportunity to grow substantially over time. However, due to their market exposure and also because variable annuities do not protect consumers against market losses, these types of annuities can be considered more risky than fixed annuities. A variable annuity can provide you with the ability for growth, but that return could disappear the next time there is a market correction or even a slight downturn, depending on the underlying equities in the annuity sub-account. There are also the annuities with the high fees, right, Jason asks? Yes, Michael replies, nodding his head. High fees are associated with variable annuities, which, like I mentioned, we don't recommend. Yeah, it was 8%, but again, with the prime rate seeking my creator, it's currently 9%. It's what we signed this morning. So again, the prime rate is something that changes every Wednesday. So as much as everybody else in the world is mad that the economy is downing, me and my clients are like, yeah, because we're locking into these higher interest rates. I actually had him with an account, and I told him if we could roll it over into this one, but I told him not to do it because it would lose 20 grand. But at this interest rate, he'd end up getting back more than that 20 grand. So it might be beneficial for him to roll that shit over. We shall see. So there's one more type of annuity to mention. Fixed index annuities. Oh, okay. I was ahead of myself when I said there are fixed annuities and variable annuities and also index. I didn't know he was going to mention indexed annuities, but that's what I sell. I sell indexed annuities and indexed life insurance. I mean, I sell everything, but the most beneficial product in certain situations is going to be those index products. There's one more type of annuity to mention. Fixed indexed annuities. It's a newer generation of fixed annuity that has its return linked to the performance of an underlying market index such as the S&P 500. With this type of annuity, when the index performs well over a given period, the value of the account has the opportunity to rise, sometimes fairly significantly. However, if the index performs poorly over a certain period of time, unlike with a variable annuity, your principal is protected and you don't lose any principal during that period. However, some index annuities do have annual fees or penalties for taking money out before age 59 and a half, in addition to a surrender charge for taking money out early. So those are those fees that all those social media gurus like to talk to you about. But they don't like to talk to you about the fees that you get from the bullshit that they put you in. That sounds too good to be true, Susan says, beaming. And this is why when I sit down with a lot of people, they go, now it feels really good to realize that just like Savings Minus Debt said, yeah, it's a glitch in the matrix. When he puts people out of the debt matrix, they glitch. They can't understand it. They can't grasp it because capitalism and finance is psychological. Right? Capitalism is psychological. So people psychologically can't get around the fact that a product this good exists and nobody's telling them about it. Everybody's telling them to go into the 401k and all these products that aren't the best for them. Yes, I hear that a lot, Michael says, laughing. A fixed index annuity can essentially provide you with the ability to obtain growth while at the same time protecting funds from market downturn. Oh yeah, that 300k annuity that I signed this morning was an indexed annuity. Fixed index annuities, additional benefits. You can turn the income stream on or off. You can withdraw a portion of the annuity's value without penalty. You can retain access to the annuity's initial value. It can provide income for 2 individuals. Now, the annuity's benefits do vary by state and may not be available in all states. New York is one of those states that don't allow jack shit. So if I have clients in New York, I'd be like, yo, can you drive to Jersey? You got an address in Jersey? Go across the bridge right quick. Get an address in Jersey so you could benefit from these index products. $10,000. My apps. And $10,000 is not in a lump sum. You can, I've done enough of these annuities. And actually, I got my license out there, but it's $10,000, right? And that breaks down to $834 a month. So, how does all of this work? Jason asks. Annuities are contracts between an individual and an insurance company. And in return for either a lump sum premium or periodic premium payments into the annuity, they guarantee a stream of income to the person named on the annuity. Michael continues, annuities are often used as accumulation vehicles for retirement savings. The money grows tax deferred, like we talked about, which is the case regardless of whether your annuity is fixed or variable. In most cases, you will be allowed to withdraw up to 10% of your contract value each year without penalty from your annuity if it's an index annuity. This means that if you have some type of an emergency and you absolutely need the funds, you can retrieve them from your account. One thing I always make sure I mention to my clients is that annuities do have a surrender period, or a certain number of years where you will be penalized if you withdraw more than the penalty-free withdrawal amount of your funds from the annuity. This means we should consider an annuity as a long-term strategy, Susan asks. That's exactly right, Michael replies. Highly attractive fixed indexed annuity features. Fixed rate of return. Just as with other fixed annuities, a fixed index annuity offers a guaranteed minimum rate of return on your money. Additional growth potential. Because the funds inside of a fixed indexed annuity are also tied in part to the performance of an underlying market index, they have the potential to return more than their guaranteed minimum. Fixed index annuities may credit interest in different ways, depending on the specific annuity. So, Malika, this is what you and I did. I believe we did a FIA. I have to double check. For example, some fixed indexed annuities use a monthly average, while others use a method referred to as the annual point-to-point. Still others use a monthly sum method of crediting interest. Growth is typically capped at a certain amount, but in return, principal is also shielded from market downturns. So let me stop there. Market participation. So when you're looking at index products, what they're doing is they are mirroring one of the indexes. So that'll be things like the S&P 500, the BNP Paribas, which is the Barclays, the MSC, the Morgan Stanley International, or the Russell 2000. Ask your modern day TV fake ass financial guru who, I trade crypto, I trade Forex, I trade options, and they don't fucking actually do it because they ain't put $25,000, which is the honest minimum amount of an investment that you can do. $10,000 is when someone is dropping their pants. That's the absolute minimum you can actually do. And generally, that's a desperation move. Now, I'm not talking about in annuities. I'm talking about in investments. Like I said, annuities, the minimum you can commit to in 1 year is $10,000. But, you know, the question is, my apps, besides how much you need to start it, you need to schedule an appointment because there's more than just starting. You got to look at strategy. Again, this is wealth beyond Wall Street. So you need to look at time horizon, exit strategy, risk tolerance, so on and so forth. But the minimum is 10 grand. So you'll want to know what indice you're getting to put in because you're going to get different interests. For example, most of the time I put my clients in the S&P 1 year point to point. On the low end, I've seen it getting about 5.7% monthly compound interest. Right? So, back to the book. Protection of principal. If the underlying index performs poorly during a given time period, principal is protected, so there will be no loss in the account. Excuse me, y'all. My nose is full. Annual reset. Annual reset value is the comparison of the underlying index's year-end value to start the following year. This will determine the amount of interest that you will be credited based upon the performance of the index and the annuity contract's terms. Depending on the insurance company, these are typically reset every 1 or 2 years. Legacy benefits. Legacy benefits can often be added, sometimes for a charge, and as an additional rider to the fixed index annuity. Here, you can help to protect your annuity's principal in the case that you have spent into your annuity funds. With this benefit, the principal can pass on in full to your beneficiary. So if you can't get life insurance, you can still fund an annuity and set it up so that it has a death benefit. This is the closest thing you're ever going to get to self-insuring, because those people who tell you to buy term and invest the difference are saying that your investments are supposed to be liquid enough that you can self-insure. Yet a person by the name of Warren Buffett does not self-insure. Elon Musk does not self-insure. So why in the figgity fuck would an average American who can't get, even if you hit the lottery, you can't get 1/100th of the wealth these guys got? But you're gonna get duped into self-insuring. Well, the funny part is I only need 3 clients with a bunch of money to fund my retirement. if I put you in those investment products. That's why earlier on in the book, the guy said, I see all these Wall Street guys in yachts, but where are all the customers' yachts? Oh, the customers are buying the yachts for the Wall Street guy. Nursing home or long-term care rider. So many indexed annuities today will offer a long-term care or a nursing home rider that will allow additional liquidity if you should require certain types of care. This means that you may be able to access a certain amount of the annuity's funds without penalty if you are required to move to a nursing home facility for a certain amount of time. Additional income guarantees. While all annuities can provide a stream of income, fixed index annuities may offer you the ability to add an income rider, sometimes for a charge, that allows additional income guarantees. These are discussed in more detail later in this guide. So can we go back to that guaranteed income for life? I still don't understand how that works exactly, says Jason. Certainly. One of the most appealing features about an annuity is the fact that it can alleviate the concerns that you may have about running out of retirement income before you run out of time. Depending on your specific circumstances, you may be able to structure the income payout stream of your annuity for a certain number of years, for the remainder of your lifetime only, or even for the remainder of your and someone else's lifetime. Income payment options, typically allowed on annuities. Life only. The life only option will provide you with income payments from your annuity for the remainder of your lifetime, no matter how long that may be. Income payments will end at your death. No payments will be made to your beneficiary. Joint and survivor. The joint and survivor income payout option is often used by couples who want to ensure that both spouses or partners will receive income for the remainder of their lifetimes. In this case, the annuity will continue paying out until both of the individuals have passed away. In some instances, the dollar amount may be reduced upon the death of the first person. In other cases, it may remain the same. Period certain. Now, you guys have heard me say period certain how many fucking times in this stream? If you choose the period certain option, the annuity will pay out a regular reoccurring payment for a certain number of years, no matter how long you live. This means that after the number of years has ended, the annuity will stop paying out income. Conversely, if you pass away early, the annuity will continue to make these payments to a named beneficiary until the end of the stated time period. So again, period certain with that 401k. Excuse me. Boy, I got gas. So let's look at that 401k again. Period certain. You can also have it with an annuity. Period certain. $200,000 period certain. You got 10 years. You're going to get $20,000 for a year. For $20,000 a year for 10 years. With that 401k, if you die, your beneficiary gets they get, I believe, a lump sum, but now it becomes taxable to them, just like it was to you. The annuity, you're getting $20,000 a year for the next 10 years. You die 5 years in, your beneficiary gets $20,000 a year for the next 5 years. So, life with period certain. The life with period certain option is essentially a combination of the period certain option with the life only option. This is because the annuity will pay out income for the rest of your lifetime. However, if you pass away within a short period of time, the annuity will keep paying out income for a set amount of time, or period certain, to a named beneficiary. I think we can all agree that everyone's retirement goals are different, right? Yes, definitely, Jason and Susan both say almost in unison. Fixed index annuities with income riders can be a great way to give yourself more control over how and when you receive retirement income, in addition to providing you with guaranteed income for life. In the past, When you are ready to convert an annuity over to an income stream, annuitize the contract, for example, you would essentially lose control of the money. This was in exchange for your guarantee of receiving your ongoing income payments from the annuity. In some cases, if you passed away, even if death occurred soon after the income payment started, the insurance company would retain the remainder of your premiums. While there are still some annuities like this available in the market today, there are also a whole new array of options available to choose from. Options that provide you and your loved ones with much better alternatives. One of these options is the guaranteed income rider. What is that? Asked Jason. An income rider can essentially offer you an additional income guarantees with your annuity. As an example, an income rider can be added where interest is paid at a variable rate with no principal fluctuations. In this case, a separate account is actually created from your base annuity account. This isn't a cash account, but simply an account from which to base your future income. The amount of income is then determined by the value in the income account and the growth credited to your account over time. This can help to provide you with a set return as well as a predictable income stream in the future. In some cases, you are also able to turn on income payments when you want them and turn them off when they are not needed. By doing so, you can manage your retirement cash flow and tax liability when not receiving annuity income. Then, depending on how long you leave your income off again, it is possible that the amount of your income payment could increase by the time that you turn it on again in the future. Annuity income rider benefits. So you get to retain access to the initial purchase value of the annuity. You can turn the annuity's income stream on or off as you desire. You can withdraw a portion of the annuity's value each year without penalty. I don't know, says Jason, wrinkling his brow. I'm still skeptical. My entire life, I've been told annuities are a scam and that only the insurance companies win out. Now, this is funny as Fiza, because again, he just showed it to him in black and white, right? And he's like, well, I'm still skeptical. Meanwhile, his entire life, he's been told the opposite about 401ks and the funds that have his heart in his stomach. But he's having that glitch in the matrix. I don't know. I'm still skeptical. My entire life, I've been told that annuities are a scam and that only the life insurance companies benefit, and that I should max out my 401k and that I'll be great by buying term and investing the rest. But what actually happened to me right now, it's opposite of what I've been told all my life. So myth number one, people will lose their money to the insurance company when they die. That's a common misconception, Michael says, nodding his head. While there are still some annuities that are set up this way, there are other ways in which you can ensure that you do not lose your premiums to the insurance company. For example, one way to do so is to opt for the return of premium rider or buy an annuity with a death benefit. In these cases, you can name a beneficiary who will receive back the premium that you paid into the annuity contract. Okay, so I can ensure that any excess cash goes to one of my beneficiaries, Jason asks. Yes, that's correct. I just thought of something, Susan said. My sister Joni told me that annuities are only for people who don't already have a retirement account. Myth 2. If you already have a retirement account, you do not need an annuity. How much income are you guaranteed to get from your other retirement account, Michael asked. Guaranteed? I don't know. I don't think any of it is guaranteed, Susan replies. Right. Michael responds, leaning forward. A 401k is a retirement account. Although you may be saving funds in a tax-deferred account, such as a 401k or an IRA, as we know, these accounts don't guarantee a lifetime income in retirement, like an annuity can. Therefore, an annuity should still be a consideration, especially as you inch closer to retirement. But how do we know returns from annuities really exist? How do we know we'll actually get good returns, Jason asked. Myth 3. Hypothetical returns aren't realistic. I understand your concern, Michael says, because I was concerned about that too. But the returns that are produced by annuities are in fact real. And when it comes to the fixed index annuities, these vehicles have actually been producing some very nice returns ever since 1995, since the very first one was purchased in February of 1995. In fact, over a 12-year period, the average return range of these fixed index annuities actually outperformed the S&P 500 in most years, keeping in mind that past performance does not equate to future performance. Michael slides the chart across the table towards Jason and Susan. So, the chart shows annualized 5-year returns. So it shows the period from 1997 to 2002. The S&P 500 had an annualized 5-year return of 9.39%. The average return on a fixed indexed annuity was 9.19%. Very close, very similar, right? Now, from 1998 to 2003, the annualized 5-year returns on the S&P 500 was negative 0.42%. Negative 0.42%. The FIA, or fixed indexed annuities, average rate of return was 5.46%. From 1999 to 2004, the S&P 500 annualized 5-year return was negative 2.77%. The fixed indexed annuities average rate of return was 4.69%. Let's see. The annualized 5-year return from 2002 to 2007 was 13.37% on the S&P 500. It was half of that in the fixed index annuity, 6.12%. But again, that's over the course of 5 years. And from 2004 to 2009, the annualized 5-year annualized return was negative 1.05% on the S&P and 4.19% with a fixed index annuity. So yeah, you had that time where the S&P did a super rally and did 13.37%. And no, because you are capped, you did get, half of the participation. However, in all of those years that I kept mentioning negatives, you kept seeing a positive from the fixed index annuity. So, after they had a chance to read the chart, Michael continues speaking. Regardless of how old you currently are or where you currently have your savings, having an annuity can be a great way to diversify your overall retirement portfolio and put you on your way to ensuring that you will have guaranteed income for life in the future. This is really making a lot of sense, Susan says, before taking a sip from a glass of water on the table. For some people, especially people worried about running out of money in retirement, annuities are a great solution. Michael smiles. But before we talk about the features you should look for when building the annuity that's right for you, I want to address the fees. I know it's something you're both concerned about. Yes, please, Susan says. That would be great, Jason says. Myth 3. Annuities charge high fees. Like we've talked about, the fees are the highest with variable annuities, which we don't recommend. I don't recommend. So, real quick, here's one thing that my boy JT the Pocket Watcher, though he is one that I disagree with because he says to buy term and invest the difference. But again, he doesn't hold his insurance license, so I don't hold it against him. Right? If he and I were to talk, because we're both financial geeks, and go through this, I promise you, he and I are gonna, listen, I promise you, JT the Pocket Watcher and I, and Orlando Minor and K Business Podcast, we about to be the 4 horsemen, because my man JT the Pocket Watcher be coming in slashing throats on y'all fake financial gurus, and I'd be loving it. And you know who else be slashing throats on y'all fake financial gurus? Orlando Minor. He be coming in telling y'all, yo, listen, I'm telling you, man, this real estate here, blah, 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 blah. And people be hitting them with hate mail. And he'd be like, yo. Then he comes back, you see the Forbes report, what Orlando Miner said was true. And then he'd be like, I thought I told y'all, I do this. I does this, cuz. But JT is one of those financial advisors who often also mentions buy term and invest the difference. Now, the reason being is because you will have a lot of, especially insurance professionals, who will tell you things like, do infinite banking, right? And luckily, JT allowed me up on his show briefly to explain infinite banking. And the fact that infinite banking is very specific. It's not for everyone. I explained to him because what happens is a lot of agents now are spewing this infinite banking, wealth beyond Wall Street, but they don't explain to you the nitty gritty. I doubt in this book it'll get to the nitty gritty. But realistically, if you're not spending $1,000 a month on your life insurance, then you're not participating in infinite banking. Now, this is if you're over the age of 25, especially as a male, because life insurance is more expensive for men. Because we go to the doctor less and die sooner. We also participate in more dangerous activities. But yeah, so, yeah, people be sending, real estate agents be sending mad hate mail to Orlando. I don't think he's gotten a view of my channel yet, because he would be over here and drop by too. So, but trust me, when I send this book over to JT, he's gonna switch up on some things. So, annuity. So, but what I wanted to talk about before I get to the high fees. So, JT will often tell you, I prefer that your insurance be insurance and your investments be investments. And I completely agree with him on that. Your insurance should be your insurance. And your investments should be your investments. Which is why I generally don't recommend variable life insurance nor variable annuities. Excuse me. So, ladies and gentlemen, I've been going for almost 2 hours. I'm not stopping. I'm going to make sure to finish this chapter. But I want to make sure, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth, or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, like we've talked about, fees are the highest with variable annuities, which we don't recommend. But like most other types of financial products, there can be fees that are charged when you buy an annuity. For example, if you choose an optional rider, such as the income rider I mentioned earlier, you may be charged an additional amount in exchange for those benefits. There are annuities that don't charge a fee, however. They will still have a surrender charge. Some annuities even give you bonuses when you get started. In comparison to investments such as mutual funds, the fees that you are charged are the same for your annuity. The fees that you are charged for your annuity are often minimal, especially as a fixed indexed annuity can offer you guarantees when it comes to protection of principal from market volatility, as well as to ongoing lifetime income retirement. Hold on. What was I about to mention there? Income for life. There was something that made me want to say a sidebar thing about the fees. Oh, so there's also, outside of fees, one of the other cool things with annuities, because they're insurance product, so you guys have heard these rappers talk about things called bands. So there are things in insurance called bands, meaning if you buy, or you actually have bands in mutual funds as well. But because I'm not going to talk about investments right now, I'm only going to talk about insurance. bands work like this. So bands are like, when you're talking an investment, they call it the coupon rate, right? And the coupon rate is a band. So if you're spending, let's say, $0 to $49,999, you're in a certain band and you're going to get less interest. So say somebody says, hey, listen, I got $48,000 I want to put away in this particular product, this annuity. Well, they're in a lower band. I might say, hey, listen, save up an extra $2,000, because if you are in the $50,000 band, you're going to get 0.15% more interest than you would in the $49,999.99 band, because you're in the low band. You're in the 0 to 49,000 band instead of the 50,000 to 100,000 band. Right? So just like with life insurance, I'll give you an example. I have a carrier that has something called a low band product. I was working with a client. She's in her 60s. And so I showed her a policy of less than $25,000. I showed her a policy for $24,500. Right? Because anything 25,000 or more, you have to get medical exams. So I got her the most she could get without getting the medical exams, and the quote closest to $25,000 death benefit, $24,500. So because it was a low band product, it was more expensive for the client because it's more work for the insurance company. So for the low band product, it was going to cost her, I think, $150 a month, or I'm sorry, $100 a month for $24,500 of a death benefit. Why? Because she didn't want to have a nurse come and take blood and urine. Okay, no problem. Well, if she has the nurse come and get that blood and urine, for that same $100 a month, she could have got a $35,000 death benefit. Everything else is the same except for she took a health exam. And she's now in a higher band of products. She's in the $25,000 to $50,000 band instead of the $0 to the $24,000. So, So, Michael looked at Jason and Susan from across the table. How does that all sound? It sounds good, Michael. Jason says, nodding his head. I understand that the growth may not be out of this world, but for peace of mind, it sounds worth it. Yes, and that chart you showed us was really helpful, Susan asked. Great, Michael said, smiling. Are you two ready to talk features? Yes, they both said. I think we all can agree that the income you have in retirement can make a big difference in your lifestyle and ultimately in your life. That's why planning for that income now is so important. Jason and Susan nod their heads energetically. When you're ready to take the next step and move forward with the purchase of an annuity, it is important to ensure that you have the right annuity for you, because not all annuities are the same. This is especially the case when it comes to fixed index annuity vehicles. Based on your needs, there are several factors you should consider. The first is the annuity's minimum guaranteed value return. You need to know the percentage return you're going to receive from the annuity. The annuity will create a rate of interest to a percentage of the premium. You also need to know which index or indexes the annuity will be tracking and the crediting method that will be used so you can monitor your changes. The surrender charge on the annuity needs to be considered as well as the contract detail, as the contractual details of the income rider. Finally, before signing on the dotted line, you want to make sure the insurance company offering the annuity is financially strong and stable. Fixed index annuity key factor. Minimum guaranteed value return. One criteria that is important to know is that the annuity's guaranteed minimum value return, such as 2%, 3%, etc. The annuity will create a rate of interest to a percentage of the premium. Index is tracked. You will also want to know which index or indexes, if there is more than one, the annuity will be tracking. Oftentimes, an insurance company will allow the annuity holder to choose from a number of different options, such as the S&P 500, the NASDAQ, etc. Crediting method. Knowing the crediting method that is being used will help you to know the changes in the index, how the changes in the index will be tracked. Another key factor to note is the surrender charge on the annuity. Here, you want to know the percentage as well as how many years the annuity will have a surrender charge imposed. Guaranteed income rider, contractual details, and any costs or charges. If you're planning to take income later on, you will also want to inquire about the contractual details of the guaranteed income rider. Strength of the offering insurer. It is also important to be sure that the insurance company you're purchasing the annuity through is strong and stable from a financial standpoint, and that it has a good reputation for paying out its policyholder claims. You can typically find out this information about insurance companies on your State Department of Insurance website. Or, ladies and gentlemen, you can literally ask the insurance agent for the company's annual report. There sure is a lot to consider, Jason says, looking overwhelmed. Yes, there is, says Susan, equally frazzled. Having a qualified professional on your side who is well-versed in fixed index annuities can be extremely helpful when you are considering the purchase of a fixed index annuity. Working with a financial professional can allow you to have all of your questions answered as you go through the process so that you know exactly how your annuity will work and how it will work for you. I definitely have a lot of questions, Susan says. Michael nods his head. While fixed index annuities can offer many great benefits, it is important to note that these products are not all exactly the same. And because of that, it is best to work with an annuity professional who can help you in determining which one may be the most suitable for you, based on your specific needs and goals. Regardless of what happens with the stock market, with interest rates, or even with the economy overall, when you own a fixed index annuity, you will have greater assurance that you will have retirement income that lasts as long as you do, guaranteed. Jason looks at Susan, who nods excitedly and asks, how do we get started? Ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, ladies and gentlemen, I need a little bit of participation here. I think I want to go through chapter 9 and read chapter 9 to y'all, but it is quite a few pages. So give me some interaction. Are y'all enjoying this? Well, you know what? I see it's a bunch of folks still in the box. So I'm going to assume that y'all are enjoying this. And I'm going to assume that we want to keep continuing. If I could get two people to put a 1 in the chat, I will continue. I'm going to step away for a second and be right back. I need at least 2 people to put a 1 in the chat so I can continue. I'm going to go get me some water. I'll be right back. supremacy. No doubt. All right, we got a bunch of ones in here. All right, so I definitely want to read chapter 9 to y'all. I'm glad y'all wanted me to continue because I skipped ahead just to see how many pages chapter 9 was, and I saw some letters that definitely make me wanna get there. So this, ironically enough, is a quote that your boy Savings Minus Debt uses often. Those who understand interest earn it. Those who don't pay it. Albert Einstein. So let's look at chapter 9. Finance yourself to wealth. Before you decide on an annuity, let me share with you the most popular strategy used to defeat all of the enemies of wealth that we've discussed today. It provides 6 important benefits. First, you're not going to lose... Oh, and I got your email broken. Okay. First, you are not going to lose money in the stock market because your money is not in the stock market. Although you could have fees and surrender charges. Second, during good years, you can grow your money based on the performance of the underlying index and crediting method used to potentially outpace inflation. Third, experts call this the biggest benefit left in the tax code because your money grows tax deferred and you can access it tax preferred. Fourth, it can provide a supplemental retirement cash flow that could last until age 100 if structured and funded correctly. Fifth, you can use your money to become your own source of financing. Sixth, it's a self-completing insurance policy. So if you pass away before you can save enough for your family to live on, the insurance benefit will provide the money needed. In very simple terms, Michael explained, the IUL, short for Index Universal Life Insurance, is a customized cash value life insurance policy. Everybody who follow me know I say this, but folks love to challenge me on that IUL. Why? Because it's a glitch in the matrix. I can't fathom. It's just like savings minus debt when you get that debt matrix glitch, because he says pull out your calculator, pull out a $20 bill. Now, type into the calculator $20, hit minus, and type in whatever your monthly car payment is. Right? And let's just say your monthly car payment is $50. Debt matrix, I can't figure it out. I have $20 in my hand. No, you don't. That $20 belongs to the bank that you owe that $50 to. Debt matrix, can't figure it out. Wealth matrix. Damn, bro, genius, I need some sound effects, man. I'm about to just drop the link so I can bring you up here to drop bombs for me, bro. In very simple terms, Michael explains, the IUL, short for Index Universal Life Insurance, is a customized cash value life insurance policy. In the next few minutes, I'm going to show you how it not only provides protection, but can be a powerful wealth accumulation tool. We are spending time here because this is the foundation. Real quick, ladies and gentlemen, just an FYI, the way this agent is teaching the clients about an IUL, a lot of people are skeptical because they're like, well, you must make the most money possible off of the IUL. They're actually, again, in the debt matrix. We make less money off of funding your IUL, plus you have to qualify for life insurance. Where, prime example, you see how my apps just said, hey, how much do I need to fund an indexed annuity? $10,000 right off the rip. It's not something that's unfathomable. But if I said, hey, my app's $10,000 for your life insurance policy, whoa, $10,000 for life insurance? That seems really expensive. Well, not if you look at all the benefits that, these 6 benefits that we just went through. But see, all you're thinking is $10,000 so I can drop dead and leave somebody a check. You're not thinking $10,000 for life insurance, which means events that happen in life. See, term insurance is death insurance, because the only thing that you get anything out of term insurance is when the person dies. But life insurance, like it says in here, is so many things you can do. Oh no, Susan cries. Hold on. I've heard both Sue Zorman and Dave Ramsey say that it's a bad idea to buy cash value life insurance. Yeah, Jason chimes in. My buddy, who's a CPA, says cash value life insurance is the wrong way to go. Lots of financial pieces I've studied paint a poor picture of cash value life insurance too. They say it's just too expensive. Now think about this. Again, the wealth matrix. They literally just told you Sue Zorman was like, buy term, invest the difference. I find that fishy information from a woman who's telling you to invest in mutual funds, but she's being sponsored by TD Ameritrade. And then when he tells you, hey, the life insurance, the thing they told you not to get, because all the things that they told you to get right now is why you're on this appointment with me and your heart is in your stomach. All the things they told you not to get, you keep telling me, wait, no, these people told me this is wrong. Wait, no, all of my experience is telling me this is wrong. Wait, no. Savings minus debt. Wait, no, all the experience is telling me I own my home when I'm paying a mortgage that I pay the interest for the first 20 years. You're financing a home. Nothing wrong with financing a home. But to my passport bros, FYI, you can't finance a home overseas, so you need to get with me and set up your at least 10-year plan so you can have the cash available to go buy a property overseas like my man Marty McFly set up with. I'm going to debunk those myths for you in just a few minutes, Michael says, and you're going to clearly see how cash value life insurance, if it's structured and funded properly, can be a very solid alternative for building wealth. Better than term insurance? Jason asks. It's in a whole different league than term insurance, Michael says. Term insurance is important for one reason: to provide for your family in the event of an untimely death. It's a bit like renting, really. You rent the insurance for a set period of years, and Malika, you already are. You started setting up the plan with me. It might not be the same numbers, but you're setting it up. So never diminish what you're currently doing. Even if you're doing the 401ks and everything's like that, because folks realize you don't know what you don't know until you know you don't know. And all the people in this industry who are licensed, like I am, know this stuff. But their fiduciary obligation, because people think that a fiduciary means that they have to act in your best interest. Realistically, what a fiduciary means is I have to tell you what I get paid off of this, and I have to tell you if it's a conflict of interest. I don't have to care about your taxes or none of that as a fiduciary. But people have been led astray. So it's a bit like renting. You rent the insurance for a set period of years, and after that term, 10 or 20 years is up, your insurance is gone. Or you have to pay way more for the same amount of life insurance because you're that much older. There's usually no equity in term policies. However, if you do happen to die during those years, your beneficiaries will receive the benefits from your policy. Michael continues. We, as Americans, spend more money insuring our cars than we do our lives. In fact, we actually do things in reverse. We focus on protecting the golden eggs, cars, homes, and other possessions, instead of protecting the goose that lays the golden eggs. Ain't that the truth? I know dudes who got insurance out the ass on their car. Oh man, don't die. They got all kinds of protection for their car. Ask them dudes to wear a condom, though. They run around with 7 baby mamas. Ask them dudes if they got life insurance. Nah, man. I'm trying to get to this real money. Stupid motherfucker, this is the real money. So, I have to admit that I'm guilty of that, Jason murmurs. Pretty much all I've got inside is my little policy through work, a term policy. But man, I sure shell it out on insurance for the cars and the house. Michael nods in understanding. Using cash value insurance like an IUL can provide death benefit protection like term, along with a protected place for your money. It's sometimes referred to as permanent life insurance. I had my kids today. I ain't about that. Word, bro. He got me over here choking. Talking about some I ain't about that life, huh? It's sometimes referred to as permanent life insurance. And it's just what its name implies too. It covers you until you die, as long as you keep the policy in force. While we've all watched the stock market rise and fall with banks and companies failing, the insurance industry has stayed solid. Did you know that during the Great Depression, while the banks and Wall Street crashed, the insurance industry not only maintained its strength, but kept its promises? During the Great Depression, clearly the greatest period of economic stress to date in the nation's history, policyholders' cash values and life insurance companies were unaffected. Contrast that with the estimated 9,000 to 10,000 banks that failed during that time. And again in 2010, when over 143 banks failed. Pause. I don't know if they're going to say it in here, but I'm going to say it because I also think this is why I have a love-hate relationship with the buy term, invest the difference, and the infinite banking. Because the reality is you should buy term. You should buy permanent and invest the rest. But if you want to buy permanent term and invest the rest. Now, permanent term doesn't exist except for what I'm going to explain to you. For most of my clients, depending on the policy that we pick and set up or the situation, which you can always make changes every 2 years, I don't think anyone should pay for permanent life insurance for their whole life, which is why I understand why a lot of people pick term. I don't think you should really pay for a whole life insurance policy for more than you should pay for a term life insurance policy, so no longer than 30 years. A lot of financial professionals don't even know that you have the option to change the amount of time that a client pays into a policy. Yes, it is going to affect some of the gains that you're going to get, obviously, because just like funding a retirement account, the more you put in, the more you're supposed to have on the back end. But I digress. Wow, I had no idea, Jason says. I like to look at history, Michael explains. From the early 1930s until about 1980, life insurance companies, not Wall Street, were the dominant architects, builders, and custodians of the nation's savings and retirement systems. Jason splits the air with a low whistle. I'm not surprised. I'm surprised. I really am. I didn't know any of that. But here's my question. My current policy, as I said, is term life. I've looked at the prices, and quite frankly, term is less money each month. Well, remember the reason we're here, Jason. It's not just to talk insurance. It's to show you how you could grow wealth without risking your money in the stock market, Michael explains. A term life policy usually doesn't provide any benefits to you while you're living. A permanent cash value policy provides quite a few significant benefits to you while you're still alive. A term policy typically doesn't build cash value, whereas a permanent cash value life policy is designed to do exactly that when it's structured and funded properly. So why isn't everyone doing this, Susan asks? If cash value is so good, why haven't I heard more about it? Stupid bitch. If the 401k was so good, but both of you guys' hearts are in your stomach, but all you heard is good things about the 401k, you actually experienced the negative, why do you think you ain't heard shit about life insurance? Sorry, I digress. I be feeling like saying that when I'm sitting in front of clients sometimes. But I realize I can't because it's the wealth matrix. Because again, financial professionals, I stand to make a hell of a lot more money putting you in the 401k than I do putting you in a life insurance policy. It's also a lot quicker turnaround time. I usually get paid in 3 days when you do an investment product, like a mutual fund. I usually get paid in less than a week once the funds clear with a mutual fund or an IRA or an annuity. And there's no waiting for your doctor's records. So with life insurance, it generally takes 30 days for us to get the medical records from your doctor. It takes a couple weeks usually for us to arrange for the paramed to come and take your blood and urine. So do you think I want to wait a couple weeks to hope that you get approved for the policy? I'll give you an example. I sat with my brother-in-law a few years ago because he was like, damn, all the family be talking shit about you, but they ain't never actually sat down to see what you do. He sat down with me, we went through it, applied for the life insurance policy. 5 weeks went by. He was like, yo, what's going on? I called the company, they declined him. And we have been going back and forth every week between him, the company, his doctors, this, that, and the third. And me and him chill. So I would go over his house, we smoke a blunt, this, that, and the third. And you know what? He was like, damn, son, they got declined. Well, at least you got paid, right? I said, no, I don't get paid if you don't get the policy. He was like, damn, son, you did all that work and you don't make $1 off of it? No. So again, we're not pushing you life insurance because it's the most beneficial for us. We're pushing you to life insurance because it's the most beneficial for you. So that's a very good question, Michael says. As good as cash value life insurance is, it's important to realize that all cash value policies don't work the same way. The criticisms targeted at permanent insurance often revolve around the fact that agents make large commissions on traditional policies. Also, too much of your money or yearly premiums go to buying insurance instead of building cash value. For the IUL, we've chosen companies that will allow you to max fund above the cost of insurance so long as the policy is not a MEC, modified endowment contract. God damn it, how many times have I said this? Now y'all will understand since a white man got a new book, because niggas love to know that white man's ice is colder. I've only been saying this shit for the past 10 fucking years. The only reason I'm pissed because my own family ain't got in on this. We could create a fucking trust. We always talk this bullshit Black America about generational wealth. Somebody go to Google. Google how long is a generation. Google will tell you a generation is between 20 and 30 years. So on the low end, 20 years, one generation of wealth is 20 years of money. So how much money is the average annual household income for Americans? It's $50,000. So do some math, somebody. Go to the calculator and put 1 million divided by 20. Or I'm sorry, 1 million divided by 50,000. You'll find that it's 20. So what does that mean? That means to leave one fucking generation of generational wealth, Black America. You need a minimum of a $1 million death benefit. Excuse me for getting on my soapbox, but damn. It's just, I ain't get shot 5 times for no fucking reason, y'all. I apologize. So, as long as the policy is not a modified endowment contract, your premiums are used to pay the cost of insurance, and anything above the cost is allocated into an index account that receives interest credit based on the performance of the underlying index and the crediting method used, which is then added to build the cash value side of the policy. Typically, this means that you can put as much money as possible towards your cash value and as little possible towards the actual insurance cost, as long as you stay within the MEC limits. Quad J, what's going on? Yeah, I guess a soapbox is cool with truth that potent. It hurts me, man. It irks me crazily because I've been saying this shit on YouTube for the last 3 years, but I've been saying this shit in my community to the hood for the past over 10 years. Past 15 fucking years. My nigga, I went to the projects where all the sex, money, murder bloods are, wearing nothing but blue bandana ties, so y'all bitch ass niggas will run up on me. And none of them bitch ass niggas and the sex, money, murder bloods who want to act like, yeah, the ops got money on my head, I'm gangster. The ops put up 50,000 on my head, I'm gangster. Yeah, you bitch ass niggas won't put money on your head, create real generational wealth, and get a life insurance policy. Yet, you bitch ass niggas want to be like sex, money, murder, blood up, gang, gang, gang. I'm the El Chapo of the hood. Somebody go to Google and type in the words Colombian cocaine cartel life insurance. You will find a December 10th article from the Wall Street Journal from New York Times. It happens to say, new hiding place for drug profits, insurance policies. It shows that 5 fucking Colombian cocaine cartel members hit $80 million of drug money in life insurance. Yet niggas always have me the bullshit. And I'm tired of that shit. Excuse me. Sorry, I had to get on my soapbox. I'm okay, babe. Y'all got my wife coming in here. Let me take my cat. I apologize, y'all. But again, I ain't get shot 5 times for no reason. To have the hood fucked up like this when you got a nigga who really here trying to teach y'all, but y'all niggas want to go fucking suck Wall Street trapper dick. So, I apologize. Let's go back. So, the vast majority of financial professionals and insurance agents don't know how to do this properly to maximize the cash value growth. Goddamn. I guess I do have to put what the fuck I say in a white man's book. They've never been trained. You certainly don't get this advanced training when you study for your license. That's why it's good to work with an insurance professional or an independent agent whose specialty is to maximize your cash growth, not your insurance costs. Going this route typically cuts an agent's commission about in half. God damn it. Why is it that I've been saying all this shit and I said this shit now? This again is my first time reading this book. Have I not said this shit? Holy smokes. So, I'm sorry. So you certainly don't get this type of training when you study for your license. That's why it's good to work with an insurance professional and independent agent whose specialty is to maximize your cash growth, not your costs. Going this route typically cuts an agent's commission about in half, but an insurance professional will gladly do it because it's better for their client. Many agents don't see it this way. They'd rather double up the commissions at the cost of the client. That is not the kind of agent you would want to do business with if you're trying to build an alternate strategy. The secret is not only working with an agent who understands how to structure the policy correctly, but also in working with companies who support the concept, Michael explains. How does this change your view of life insurance? I thought about this today. The hood propaganda worked. We all have to recognize that, good or bad. Again, let's step back a moment from the story and review the key ingredients for building an IUL to accomplish what we have talked about. Here are a few of the most important pieces. And before I lose my voice, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So this is why, ladies and gentlemen, when I be saying what I say and people be like, yo, you ain't afraid people is going to take it and run with it? My nigga, I don't care. Just like this homeboy in this book said, you know how many agents get this shit and fumble the bag because they don't know what the fees up they doing? Again, it's just like, I say it all the time, it's like Kareem Abdul-Jabbar in the Skyhook, right? Every NBA center who's considered a good or a great has tried to work with Kareem Abdul-Jabbar. And he said the Skyhook is probably one of the simplest shots in basketball, yet no fucking body can do it. Thank you, broke genius. Right? Yet nobody can seem to do it. But a whole bunch of people seem to be trying to work with Kareem, yet he's the only one who's mastered the Skyhook. Now, LeBron actually came pretty close. He was going to break. LeBron's probably the only other one who can do the Skyhook well. But LeBron is the GOAT, so, you know. So, let's step back a moment from the story and review the key ingredients for building an IUL to accomplish what we have talked about. Here are a few of the most important pieces. 1, you want an insurance company with a long history of success and financial stability. Companies that have been in business for over 100 years. 2, you need an agent that has been trained to structure a policy for maximum cash value growth and with minimum death benefit without hurting your tax advantage. 3, you need a company who will allow you to maximize your cash value growth while minimizing your insurance costs. This is critical. So you may have also heard of 2 agents, and one your boy JT the Pocket Watcher actually brought up. One is a guy who works for a company called Life 180, or a YouTube channel called Life 180, Chris Kirkpatrick, and there's another guy who is Dr. Jake Jacobs, and they both prefer infinite banking with traditional whole life, which fucks you, the client, over. It gets them a nice 50% commission, since they wanted to talk about, well, ask your IUL agent how they get paid based on commission. Yes, I get an advanced commission. So if you put $1,000 in and I get a 50%, which is cut to 25%, meaning you pay $12,000 a year, I get a $3,000 check. But I'm responsible for you keeping that policy for the entire year. Meanwhile, with a traditional whole life trying to do infinite banking, they absolutely get 50%. Generally, they're with companies that give you higher percentage. So their percentage rates are generally 125%, especially because they're general agents. So as general agents, you can get up to 140%. So yeah, they'll get that full 100%. They'll get paid the $12,000 that you put into the policy. But a traditional whole life is not the best thing for you. They'll tell you, oh, well, the guarantees. Oh, well, when you're pulling money out, if you're setting up this policy properly, you're supposed to pull money out. It's not supposed to have certain quote unquote guarantees, but you can always put your foot up their ass with that by saying, yeah, IRC 7702, don't fuck with me. Then your boy Chris Kirkpatrick was talking about arbitrage and arbitration, and I'm like, listen, you're trying to get in the weeds, bro. You're talking to people who don't know what they're doing, but I am a person who knows what I'm doing, so you can't pull the wool over my eyes. Now, a client doesn't understand that. Now, also number 4, When you take a loan, your money can continue to grow as if you've never borrowed against your policy. Let's say you buy the finest quality chocolate bar available, representing term life insurance. You love chocolate and you would love nothing more than to sink your teeth into that bar. But the people from whom you bought it said you can't do that. By law, you have to put it away. You can't touch it. It won't go to waste though. As soon as you die, your heirs get to savor that chocolate bar on the way home from your funeral. Who wants to buy a chocolate bar that they can't even enjoy? You sure wouldn't want to pay much for it, would you? That's why term life insurance is so popular. It costs less. In fact, it's the smallest amount of money you can pay in premiums and still provide a death benefit for your beneficiaries. But to take a look at the reason it costs so much less. It's only in effect for a specified period of time. And it provides benefits only to your beneficiaries. There's no benefit to you. Okay, back to the chocolate bar metaphor. Now, say you buy the finest quality chocolate bar available, representing cash value life insurance. This time, though, you're able to savor that chocolate bar while you're still alive. In fact, your chocolate bar keeps getting bigger and bigger. So not only do you get to just keep enjoying it, but when you die, your beneficiaries will have an even more of the chocolate to enjoy it together. And while they're enjoying the smooth sweetness, they'll do so with the satisfaction of knowing you enjoyed it too. Those shits are slapping. Basically, what happens, Michael explains, you buy a properly structured cash value life policy that you agree to pay into each month. Your money is not invested into the market. Your premium payments are used to pay the cost of insurance, and anything above those costs is allocated into an index account that receives interest credits based on the performance of the underlying index. Even if you borrow from it, and even when you take tax advantage cash flow from it during retirement, you've got an alternate financial product that can provide a cash flow for you in retirement as long as you pay your premiums, and it is structured and funded properly. Your principal is protected from market downturns, so you won't lose it during market swing. You will still have costs and expenses, and some years you might not make a return, but your policy will not receive a negative crediting either. And you get what we call living benefits from an IUL. There are actually several other wealth accumulation options you can use depending on your situation and your goals. There are also income for life options that can guarantee you never outlive your money. This can be a great peace of mind for folks getting into retirement. There are also what we call supercharged IULs that allow you to benefit from the ups of the market without losses due to the market volatility. This is really exciting, and we'll cover this subject in another chapter. From here on, when we and Michael talk about cash value insurance, we're talking about the kind of IUL that provides these benefits to you. Just about anyone can use it, and you don't need to be educated or experienced. It can work on autopilot. You don't have to watch the market, reassess stocks based on performance, or worry about tax consequences as long as it's structured and funded properly and you can qualify for the insurance. Which is why when a bunch of people be asking me, what's your thoughts on this stock? I think this shit exists and you're stupid as fuck for buying stocks instead of life insurance. But if I say that to people, it kind of offends them, right? But that's really what happens. No offense to nobody who has asked me that question, because I've had people who are actually in here who have asked me this question. What's your thought on this? But now that I've read this to you and broke it down to you by the way of a person who's kind of marketed it, what do I think of any fund? I think if it's not an index universal life insurance policy properly funded, you're stupid as fuck for going into it because you don't have the risk tolerance to lose $10,000. So I think it's the stupidest fucking thing you could do. I think it's like actually walking through hell with gasoline drawers thinking you're not going to be burned. That's what I think of XYZ fund. That's what I think of XYZ stock. To be honest. Now, I think if you're in a financial position to actually be able to properly invest and you have the risk tolerance, then that's a different conversation. But 95% of the people that I talk to who, listen, I talk to a lot of people who make over $150,000 a year. Still ain't enough for you to be talking about investing. If you look at what is an accredited investor on Google, it will tell you FINRA sees an accredited investor as a single person, one who's made at least $200,000 a year for the past 2 years, expected to make it for the next year. And if you're married, at least $300,000 a year for the past 2 years and expected to make it the next year. Or if you don't have those income requirements, you at least have a net worth of $1 million outside of owned real estate. So I think if you're not making $400,000 a year, don't fucking say the word invest. Because you're not properly in a position to benefit from it. But I think what happens is Sue Zorman, Dave Ramsey, and Jim Cramer get rich as fuck off of this shit. And people like me who are licensed financial professionals get rich as fuck off of this shit. Just like a real estate agent will tell you to buy a fucking house right now while the interest rates are at 9% because you can refinance. So they're telling you, buy something that you're going to pay basically interest up front for the next 30 years, and then 10 years later, you're going to start over again on something that you really don't know will appreciate. We think real estate will appreciate, but remember, everything goes up in cycles. So what was the hood may not be the hood today, but if there's something that was the hood that wasn't the hood, or excuse me, if there's something that was the hood that now isn't the hood, that means that there's something that wasn't the hood that now is the hood. So those properties decrease in value. So what do you think happens? Well, it just flip-flops. So the neighborhood that was the hood 20 years ago when you first bought the house and was like, it ain't the hood now, well, now it's the hood again. So, let's go ahead and while it requires a bit of patience, and depending on what you're trying to accomplish, it can work whether you have thousands or just a few hundred to set aside each month. 9% is a lot for everybody, Malika. Keep in mind, like with anything, the shorter your time horizon, oh my God, we don't hear these fake-ass financial gurus say time horizon at all, do we? The more you have to put in, or be open to the possibility that you will need to adjust your time horizon. Now, let's get back to the story. So far, it's sounding pretty good, says Susan. But what do you mean by living benefits? Well, I've already mentioned a few, Michael responds. The IUL gives you protection that is guaranteed by the insurance company that your principal is immune from whatever the stock market is doing. You'll have costs and expenses even in years you may not receive the interest credit. However, your policy will not receive a negative crediting because of a market downturn. Another benefit is taxes. The IRA expert Ed Slott, who I mentioned yesterday, God diggity damn, says life insurance is the single best benefit to the IRS tax code. Hold on. I'm typing that in here because he's a CPA. He does not sell insurance. Everybody go to YouTube and type in this guy's name and just watch some of his videos. Again, he can get his license to sell life insurance because CPAs can get their license to do that. But CPAs generally aren't very familiar with insurance. So they don't even, that's why they tell you to buy a term and invest the difference, because they have no fucking clue how insurance works. Just like I have my PTIN, my Prepares Tax Identification Number, but I wouldn't try and negotiate a compromising, offering compromise with the IRS on your behalf, because I'm not a fucking accountant. I can do taxes because I have the license to do so, though. Yeah, man, these gems are dropping all over the place. That's all right. As long as you listen to Malika, I'm happy. And I got 6 folks in the box. So, life insurance is the single biggest benefit to the IRS tax code. You save taxes on the growth of your principal. You can access the cash value without paying taxes. And when the death benefit is paid out to your beneficiaries, it comes to them income tax free. In most cases, you pay taxes on the money before you put it in the policy. And remember that one of the risks of the 401k plan and mutual funds is the risk that the government could change the rules midstream due to the latest political agenda or bureaucratic whim, Michael says. With an IUL, your policy is a private contract between you and the insurance company. Of course, one of the greatest living benefits is the ability to reduce or totally stop paying interest to banks and finance yourself to wealth, Michael explains. How does that work? Jason asks. Well, we'll use a car for an example. Let's say you want to buy a $20,000 car. You can go get a loan from the bank or a car financing company, or in your case, you can use your IUL to finance the car. Yes, have I been saying this for years? With traditional car financing, you might finance the car for 5 years or so. In the end, you have a car paid off and you've lost all the interest and principal to the finance company. When you finance yourself to wealth, you borrow against your IUL policy and pay for the car in cash. Often paying cash can save you money on the purchase price by itself. Then you make payments back to your policy. This is where it gets exciting. After the 5 years, you've got your car paid off, but you also have the $20,000 back into your IUL. Plus, you can pay additional interest with your payments, and the extra money will only go to increase the cash value. This is why we call it financing yourself to wealth, because each time you take out a loan and pay it back with extra interest, it can increase your cash value. That sounds interesting, Susan says. With a cash value insurance policy, Michael continues, you have access to the cash value in your policy and you can't be turned down for a loan. Pause. So, you guys don't seem to understand, when you're going for a loan of any type, the only way you get approved for the loan, you might have $1 million cash and go for $1 million loan. The only way you'll get approved for that loan is to show your ability to pay back the loan. Even when you're retired and you take out a home equity line of credit, that home equity line of credit is only extended to you based on your ability to pay back the loan. Guess what you don't have to do with a cash value line of credit or a cash value loan from your life insurance policy? You do not have to even pay it back, nor do you have to show the ability to pay it back. Yet even people like JT the Pocket Watcher will tell you some wild off-the-wall shit like buy term and invest the difference. Again, JT don't know because he doesn't specialize in life insurance. But that's like him, a CPA, kowtowing to me, telling you, hey, you owe the IRS some money, just call him and get an offer in compromise. After you're already in a certain predicament, he's gonna be like, they're not gonna give you an offer in compromise, dude. You're already past that, and your assets don't show. Da 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 da. Man, don't listen to CPA. Them niggas don't know what they talking about, man. Just get an offer in compromise. The best thing smoking. And then because I'm popular, everybody, I'm gonna get an offer in compromise. I'm gonna get an offer in compromise. And then the people who actually give a damn about you, like JT, comes out and is like, you shouldn't do that. I actually hold my CPA. Oh, well, Tax Street Trapper over here, he's helped so many people. You're just jealous, JT. And what does a license mean anyway? It doesn't mean jack shit. No, that's because you want to suck the dick of the person who's telling you the bullshit because the bullshit sounds nice. It's kind of like that dumbass nigga who got these 7 women pregnant, right? It sounds nice because, or it has those 7 baby mothers. It sounds like he was being responsible. Well, yeah, you know, I mean, I told him, lady, that I ain't want to be I ain't want no kids, and I was willing to pay for the abortion. Just like these dumbass niggas who fall for, I haven't had anybody, I never did this before. Next thing she giving you guac 3,000. But I never did this before. You never did this before? Because you performing like an adult film star. You go, right? Sounds nice. So we want to fall for what sounds nice. So that sounds interesting, Susan says. So, with a cash value insurance policy, Michael continues, you have access to the and you can't be turned down for a loan. If you need to borrow the cash value from your policy, just say the word. No credit checks, no tax return, no qualifying hassle. And no one's going to raise your interest rate if you're late on the payment. In fact, you determine the repayment timetable, and you decide how often and for how long you want to make the payment. This almost sounds too good to be true, Jason says. It gets even better, Michael responds. Remember when we talked about how one of the enemies of wealth is interest? Well, when you use your IUL to refinance finance your purchases, your money continues to grow as though you never touched a dime. When you pay the loan back, you recoup the loss of that purchase back into your policy rather than making payments to someone else. You can enjoy some of the things you like without destroying your nest egg. By this time, Jason and Susan are both wide-eyed. There's got to be a hitch, Susan says, and I can think of a big one. I'm not sure we'd even qualify for insurance right now. I just had some really serious health problems, which I hear all the time. In fact, I'm gonna put her on blast. I have a family member of mine in California who I introduced to an agent of mine because she said she's interested in getting the life insurance, blah, blah, blah. She's 57 years old. So when my agent calls her for the appointment that she set with her, my cousin is suddenly like, oh, I know I scheduled this time specifically for you, but suddenly I have to speak to this attorney. An attorney I know doesn't fucking exist. But since you want to give us bullshit and tell us it's roses, I'm gonna put your business out there. Get mad at me. I don't give a fuck. I was coming to help you, but you won't give me your ass to kiss, so don't be surprised when I give you my ass to kiss. It's a cold world, ain't it? You don't like when the rabbit have a gun. So she says, oh, also, I can't reschedule today because I'm having some health problems. Okay, so my agent says to her, well, just so you know, it would probably behoove you to get this stuff now, because I'm looking for this on the proper IUL. Mr. Not sure what else you're looking to accomplish, but if it's a wealth or financial goal, literally this book is telling you this is probably the first thing you need to do. I digress. So then she goes, and also she had an attitude with me because she was talking about some, well, if you're going through health problems, it's going to be in the system. And that's true, because again, you might not qualify for the life insurance. This is an almost 60-year-old black woman in California. You got grandkids, you say, you got kids and grandkids. Again, black folk keep talking this generational wealth bullshit. But then want to turn around and when I say $1,000 a month on life insurance is going to create generational wealth, it's going to create all this good stuff for you. I need to think about it. But then turn around and be like, girl, I'm about to get them Beyonce tickets. Hey, I just spent $3,000 on this fucking pit bull. What the fuck? Nigga, what? Craziness. So, no, don't hand me the bullshit. So, where was I? So, by this time, Jason, why did yeah. So, I just had some really serious health problems. If you're too old or have health issues that might make you uninsurable, you're not out of luck, Michael explains. You can buy a policy on a child, spouse, or grandchild who does qualify to be insured. You own the policy, and you still control it, so you get to decide what happens to the money. So let's assume you can qualify. If your policy is babe, what you cooking? Oh, what do you need from this store? What's up? Okay, so give me like 10 minutes and I'll pause on this, because whatever you cooking smell good as hell. Okay. Yeah, I was gonna read the rest of this chapter, but I got quite a few pages left, and I gotta run to the store because my wife is making a turkey breast, and that shit smells hella good. I'll at least read the next few pages though. So qualify. You can. So let's assume you can qualify. If your policy is structured properly, your policy is permanent. That means as long as you keep it in force, it will be with you forever. This is extremely important when it comes to taxes. Also, Mr. That's the reason you want to do it sooner than later. Because tomorrow you might end up with a hacking cough and you end up going to the doctor. And now because you know, you have to be very transparent with the agent. If you didn't know, or if the doctor didn't know, it's probably for the better, right? I'll give you another example. A friend of mine, mother had cancer. He called me and was like, yo, I want to try and get my mother some life insurance. So I scheduled the appointment with her. Yo, let's do da-da-da-da. I said, okay, you're going to the doctor soon. Let's go ahead and have you sign the application so it'll already be enforced. So whatever the doctor says, it's not whatever. Well, she waited and she waited and she waited. And then when she got to the hospital, she was diagnosed with stage 4 cancer. So she was guaranteed to die. She died a couple months later. However, because she didn't sign on the dotted line, guess what she didn't have? Life insurance. So guess what my buddy had to do? Come out his own fucking pocket to pay for his mother's funeral. I'm not trying to give niggas an I told you so, but this is the bullshit we keep doing. So that means as long as you keep it in force, it will be with you forever. This is extremely important when it comes to taxes. Life insurance is one of the best estate tax planning vehicles there is because it gets paid to your estate income tax free. Michael adds, there's another one of the great benefits. Your life is insured. The average man in this country has an economic value of more than $1 million. If you die, especially if you die early, your family could suffer a significant economic loss. On top of your emotional sorrow, on top of the emotional sorrow of losing, the death benefit of life insurance provides financially for those you leave behind. In fact, as long as it's enforced, your policy will generally pay out a lump sum income, tax-free death benefit that's far larger than the total premiums. It multiplies your money, motherfucker. You put $1 into life insurance and die the next day, your family get the $100,000 you paid or you bought. It would take you 100,000 months of saving $1 a month to get there. And now I just want to do some math. I'm gonna go to Google because I want to see how long is 100,000 months. Pull up my tablet. Give me 1 second. Yes, I know we tend to procrastinate. But we don't procrastinate on bullshit. I know a bunch of people who didn't procrastinate on them Beyonce tickets. I know a bunch of people who keep procrastinating. Oh, Alonzo, I ain't forget about you. I want to set up. All right, cool. No problem, brother. He said, I'm not trying to buy a $3,000 pit bull. That's a good one. I want to see something. How long is 100? Well, how long is 10,000 months? Let's just do that. So 10,000 months is equal to 833 years. That's ironic. I guess it makes sense. 834 years. 833.33333. So, and that's just 10,000 months of saving $1 a month, which would be 833 years. That's how you would get your family to $10,000. That's what I'm going to start telling people. Yeah. 8330, yeah, so 8,333 years. Or you could give the insurance company $1 today. Because how many people you know right now who are shit? How many people do we know live to 83 years? Right? But how many folks we know walking around right now are 8,333 years old? None? How many structures on Earth do we know that are currently 8,333 years old? I think the pyramids are like 4,000 or 5,000 years old, is what they say. Well, damn. Anyway, I got to do this pretty quickly. So, now, keep in mind as we're referencing financing yourself to wealth, we're talking about policy loans, not withdrawals. Withdrawals are when you permanently take the money out of the policy. The reason why we use loans is because your money continues to grow. If you're using an indexed or variable participating loan, even while you're using it, then as you pay it back, it is there for you to use again and again. So what happens if we can't pay the loans back, asked Susan. The idea is to be able to structure the loan so that they can be paid back similar to a regular car loan. If, for some reason, you can't make payments for a while, it's not a huge deal. No one will be knocking on your door to collect. You simply resume paying when you can. If you pass away before you pay the loan back, then the loan and interest on the loan will be subtracted from the death benefit, and what's left over will be paid out to the beneficiaries. However, you definitely want to pay the loans back if you're using them for financing yourself to wealth. What happens if for some reason we can't, Susan asks? You'll want to continue to pay interest on the loan because the loan interest will accrue and ultimately the policy could lapse and cancel. Just like gardening, if you stop watering a plant, it stops growing. We want to keep nurturing the IUL so it continues to grow. This goes back to making sure your policy is properly structured and funded. Then, once you hit your retirement years, we have conservatively structured your policy so you have enough cash value that the interest from the policy from the index is paying for the cost of insurance and you have never have to pay more premiums into it. It can then be there to provide tax advantage retirement cash flow. But, Michael says, here's the real beauty of a loan from your policy. You structure the repayment schedule. You determine how much you can pay, and you determine how often you want to pay. Makes sense. But is there a limit to how much we can put in, Jason asks? Yes, Michael says. We want to make sure that your policy doesn't become a MEC, modified endowment contract. In order to enjoy the maximum tax benefits of your IUL, you want to keep the policy within the MEC limits. If you don't want to end up in a box, things outside of it. Cartoon cat. So, ladies and gentlemen, I'm going to pause there. I'll probably come back in a few minutes after I go to the store and eat and all that good stuff, just to finish the chapter, because I want to finish the chapter for us. But ladies and gentlemen, I've been going for 3 hours. If you enjoyed the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, ladies and gentlemen, when people challenge,
They don't challenge you to challenge, but they challenge you to challenge. Accept the challenge. Salute.